is on international standards on auditing, on audit planning. There are many international standards on auditing. One such standard deals with audit planning, and the primary international standard on auditing that deals with audit planning is International Standard on Auditing number 300. ISA 300 is the primary standard, international standards on auditing, that deals with audit planning. It is the core standard. Though there could be other standards that are related to planning, ISA 300 is the core standard on audit planning. And in this lesson, we are going to summarize some of the key requirements and guidance from ISA 300. So the objective of the auditor is to plan the audit so that it will be performed in an effective manner. You understand? So ISA 300, the standard is known as planning an audit of financial statements. Planning the audit of the financial statements. ISA 300 is about planning an audit of financial statements. Objective of audit of the auditor, ISA 300. The objective of the auditor is to plan the audit so that it is performed in an efficient, effective manner. So what are some of the requirements or the guidance of this standard 300 on auditing? Okay? On audit planning. So one requirement is involvement of key engagement team members. There has to be involvement of key engagement team members. Involvement of key engagement team members. The standard emphasizes the involvement of key engagement team members in planning of an audit. The engagement and other key members of the engagement team are required to be involved in planning the audit, including planning and participating in the discussion among engagement team members. And this emphasizes the importance of experienced personnel being involved in the critical planning phase. The second requirement of International Standards on Auditing 300 is preliminary engagement activities. Preliminary engagement activities. Preliminary engagement activities. Before establishing the overall audit strategy, the auditor is required to perform various activities at the beginning of the current audit engagement. For example, performing procedures regarding the continuing of the client relationship and also specific audit engagement. There is evaluating of compliance with the relevant ethical requirements. There is the aspect of establishing an understanding of the terms of the engagement. So that is the second requirement of ISA 300. The third requirement is in relation to the establishment of the overall audit strategy. Establish overall audit strategy. Now, what does the standard say about establishing overall audit strategy? The auditor is required to establish an overall audit strategy that sets the scope, timing, and direction of the audit, and that guides the development of the more detailed audit plan. Understand? Establishing the overall audit strategy. In our previous sessions, we defined what an audit planning strategy is. Let's move on to the fourth requirement of ISA 300, which is developing an audit plan. Developing an audit plan. Developing an audit plan. That is to say that the auditor should develop an audit plan that includes the description of the nature, timing, and extent of planned risk assessment procedures. That is very critical. Then, of course, we have documentation. Number 5, the standard is also not silent on documentation. The auditor is required to document the overall audit strategy and the audit plan, and any significant changes made during the audit engagement to the overall audit strategy or the audit plan, and the reasons for such changes should be documented. You understand? And that emphasizes that planning is an iterative process. After the strategy has been developed, the plan has developed, but there could be changes along the way. So such changes have to be documented. Documentation. Then there is consideration in initial audit engagement. Considerations. 6 considerations in. We have the other aspect of ISA 300 is considerations in initial audit engagements. Considerations in initial audit engagements. This is also one of the requirements of International Standards on Auditing 300 on planning. For initial audit engagements, the auditor has additional considerations. Initial, if you are auditing a company for the first time, that's what we are calling initial audit engagements. There is the continuing engagement and initial engagement. For initial audit engagement, the auditor has additional considerations, including performing procedures regarding clients' acceptance and continuance. There is also communication with the previous or predecessor auditor, if any, in accordance with the relevant ethical requirements. The planning standard, the standard on planning requires that the auditor to conduct further procedures if the engagement is new, like contacting the predecessor auditor and carrying out other procedures in that regard. So that is it, candidates, for this standard. The International Standards on Auditing, on Audit Planning, that is ISA 300. We've in this lesson discussed some of the requirements and guidance of the standard. One is in relation to involvement of key engagement team members. Number 2, preliminary engagement activities. The standard also provides guidance on establishing overall audit strategy. Number 4 is development of an audit plan. Number 5 is documentation. And lastly, considerations in initial audit engagements. And that's the end of the lesson and the end of the topic in principles of auditing. Bye-bye. I welcome you once again to the Manifested e-learning platform. The subject is Principles of Marketing and Communication. Today, we are proceeding with the first chapter, and we are going to learn the importance of marketing. That is our focus for today. We will be discussing the importance of marketing, and therefore, by the end of this lesson, we should be able to explain the importance of marketing. If you recall, in our last session, we defined 3 key terms of marketing. One being market, number 2, marketing, and market research. We defined a market as a group of all the actual and potential buyers of a particular product or service. We went ahead to define marketing as the process through which organizations identify customer needs, engage customers, and also build strong relationships by creating value for customers in order to earn value in exchange. So that's the meaning of marketing. Today we want to discuss the importance of marketing. And marketing, we know, is vital to both business organizations and also the economy, and it performs various roles. And the first role or importance of marketing is identifying customer needs. One, identifying customer needs. That's one reason why marketing is important. Identifying customer needs. Marketing helps organizations understand what customers want through market research and feedback. For example, by providing or studying customer preferences or income levels, or by studying tastes and buying behavior, organizations are able to design products and services that meet real market needs rather than guessing. So instead of guessing, a company can, through marketing, identify customer needs. For example, an institution like Manifested Publishers, which offers Kasneb online tuition, may survey students to know their preferred study times and course formats. And the course format could be online format or physical format. And that ensures that services meet students' needs. So instead of just guessing what students may want, marketing may help the organization to first identify the needs of the customer, then develop products that meet the needs that they have been identified. So that's one reason why marketing is important. Identifying customer needs. Number two is creating awareness. Marketing creates awareness. Marketing informs customers about the existence, the features, and even the benefits of products and services. And that can be done through advertising, through promotions, through social media, and marketing with the products of the company, creating awareness. You recall we did mention that marketing is very broad in scope, and it includes not only identifying customer needs, but it extends to promotion, to distribution, and so on, including customer relationship management. So through marketing, the organizations or companies can create awareness of their products. They can create awareness of the features of the products, the benefits of the products, and so on. You understand? For example, advertising the Kasneb online tuition or classes on social media platforms helps students become aware of the available courses and the enrollment periods. I know some of you came to know about Manifested through marketing. Manifested may have done marketing on social media, which caused you to know the existence of the products at Manifested Publishers. So that's one reason why marketing is important. Creating awareness. Creating awareness. Number two or three, marketing promotes profitability and sales. Promotes profitability and sales. If you are running a company and you want to increase your profits, that can be done through marketing. Effective activity stimulates demand. Effective marketing activities can stimulate demand. You understand? Yes. Marketing activities can stimulate demand, leading to increased sales, leading to increased profits. Effective promotion, pricing, effective distribution strategies encourage customers to purchase products, which then improves the revenue and business growth. The company may offer discounts on say television, or on if it's a company that is selling televisions, the company may offer discounts on the televisions or any kind of product, which then promotes profitability and sales. Number 4, marketing facilitates exchange. Facilitates exchange. This is exchange of value. Marketing links producers and customers, which then enables the exchange of goods or services for money. The value that the customers get from the products would be from the companies is products or services. The companies sell value in form of products or services, and the companies receive money or loyalty in exchange of the products that are sold to the market. So through marketing, there is that exchange of value between producers and the consumers. You understand? Through proper distribution channels, through pricing and communication, marketing ensures products reach the right consumers at the right time. The products reach the consumers at the right time. That is one reason why marketing is important, because there are times when you may have products and the products may not be needed at certain times. The products may come late or even later when the need has already been met, or when the times are not for the products to be consumed. For example, online platforms allow students to register, to pay, and also access study materials, which makes the exchange process very smooth and efficient. So marketing facilitates exchange of value. Number 5, encourages innovation. Marketing encourages innovation. And how does marketing encourage innovation? Now, marketing feedback drives product improvement. It drives product development of new products. You understand? When you get feedback from the market, because marketing involves also studying the needs of the customers. When the company studies the needs of the customers, the company gets ideas on how to improve their products, and that encourages innovation. Product development is made possible through marketing because of the feedback that the company gets from the customers. The company may also receive complaints from the customers. Customer complaints, suggestions, and also the changing tastes may guide the business in improving existing products or introducing new ones. For example, students requesting recorded lessons may lead to the introduction of pre-recorded video lectures. You understand? A company may introduce pre-recorded video lectures as a way of responding to feedback from the students. So that encourages innovation in form of coming up with the pre-recorded lessons. Then the 6th reason why marketing is important is that it enhances customer satisfaction. Marketing enhances customer satisfaction and customer loyalty. Through marketing, customers may become loyal to a company, or they may be satisfied with the products or services that are offered. Marketing helps build long-term relationships with customers. Through marketing, a company can build long-term relationship with its customers. For example, by meeting expectations and offering, say, after-sales support, firms create satisfied customers who remain loyal and make what we call repeat purchases. So through marketing, customers get satisfied and that leads to customer loyalty. That's why marketing is critical. You understand? 7, marketing supports economic development. And how does marketing support economic development? Now, marketing contributes to overall economic growth because it creates demand for goods and services, leading to increased production, and increase in production leads to increased employment. It leads to income generation. Increased production may also lead to tax revenue. You understand? For example, it manifested because of the introduction of online educational classes or services that has created jobs for lecturers, it has created jobs for video editors, it has created jobs for the support staff, and that in itself increases what we call or supports economic development. We have IT support staff, we have content creators who are then graphic designers who contribute towards economic development. So these are 7 reasons why marketing is important. Today we've studied the importance of marketing. One is that marketing identifies customer needs. Through marketing, the consumers get to know about the existence of products, the features of the products, and so on. Number 3, marketing promotes profitability and sales. Number 4, marketing facilitates exchange of value between the producers and the consumers. Number 5, marketing encourages innovation. And this innovation is made possible as a result of receiving feedback from the market. When companies receive feedback from the market, from customer complaints, from customer suggestions, that drives innovation. Then 6, marketing enhances satisfaction and loyalty of customers. And lastly, marketing supports economic development. So these are 7 reasons why marketing is important. Thank you for attending the lesson. In our next session, we continue with our lesson on marketing and communication. Bye-bye.
We pick it up on illustration, that is the taxation of trustee. Our first question comes from April 2023. April 2023. Question 5C. Question 5C. April 2023, question 5C. We'll read the question. Malezi Trust was formed in the year 2021 for the benefit of Alex Malezi's 2 children, Mona and Nora. The following information was provided to you by the trustee in respect of the trust income and expense for the year ended 31st December 2022. Additional information 1. The trustee reported trading profit of 160,000 for the year. This was after deducting the following expense: printing and stationery, 1 million shillings, legal fee out of which 1,200 was in respect to defending, out of 1,200 was in respect of defending one of the trustee involved in illegal business deal. Then we have tax consultancy, a figure of 2.4. We have the next, that is purchase and installation of a software, a figure of 2 million. We have trustee salary as per the trust agreement, and that was 10 million. Then you have loan repayment, into bracket, interest included, a figure of 1.1. The total was 8 million. Then you have lease charges, were shillings 3 million, out of which 600,000 was in respect to drafting a 10-year lease agreement. Then we have what we call preliminary expenses in respect of the trust formation was 3.4. Then we move to the additional information number 2. The trading profit was before taking into account the following capital expenditure: a warehouse, that is from 1st April 2022, a figure of 3.5 million. Then we have delivery van from 5th May 2022, we have a figure of 1,750,000. We have saloon vehicle from 1st January 2022, the figure is 3.8 million. Then we have the sports pavilion from 1st September 2022, the figure is 1.2 million. So we're being told that trustee received a gross rental income from the commercial properties of 120 million. And the gross interest income from fixed deposit of 20 million. Then you're being told that fee paid to investment manager in charge of the rental property was a fixed deposit amount of 12 million. Additional information number 4. We're being told that each beneficiary is entitled to a quarter share of the net distributable income. That each beneficiary, we know that there are 2 sons, that is Mona and Nora, is entitled to a quarter share of the net distributable income. Then you're being told that the fixed annuity of each beneficiary was shillings 10 million. The figure is gross. Then you say that trustees made 6 million to Nora and 3 to Mona and 3 million to Nora as discretionary payment as per the agreement. Then required. One is that compute the income tax payable on the trust income for the year ended 31st December 2023. Then compute the amount due to each beneficiary for the year ended 31st December 2022. We begin the analysis. Malaysia Trust was formed in the year 2021 for the benefit of Alex Malaysia's 2 sons, that is Mona and Nora. The following information was provided to you by the trustee in respect of the trust income and expenses for the year ended 31st December 2022. So the first additional information, we're being told that the trustee reported a profit of 160 million for the year. This was after deducting the following expenses. At that very point, we noticed that for this particular question, the method that we need to get the taxable income is basically what we call the net profit method. And the reason that underlie that is because we have been provided with the accounting profit. So the first expense that was subtracted, we are being told that printing and stationery, a figure of 1 million, that should be allowable expenses, that should not be adjusted. Then however, number 2, additional information 1.2, legal fee of 6 million, out of which 1.2 was in respect to defending one of the trustee involved in a legal business. So there's a 1.2 that we treat as an unallowable. If we have a 1.2 that we use to defend a trustee that was engaged in a legal business, then that should be what we call a non-allowable expense. And note that we say that for this particular question, we are using the net profit method. It means that we need to add back a figure of 1.2, which is a non-allowable expense. The implication of subtracting a non-allowable expense is that you understated the net profit that was provided as 160. So we need to add back that figure of 1.2 to get the right position of profit. Then we have what we call tax consultancy fee was 2.4. We say from tax expenses like the tax consultancy, those should be non-allowable expenses. By subtracting that 2.4, you underestimated the profit. So the correction would basically be to add it back. Then the next we have purchase and installation of accounting software. We know that accounting software that we've been told that is a capital expenditure. So we need to add back that figure of 2 million. Then you're being told that trustee salary as per the trust agreement, that's 10 million that should be allowable. Then we have loan repayment. We are told that out of that there's an interest of 1.1. So the loan repayment total was 8 million. So interest on loan is allowable expenses, but loan repayment is a non allowable expense. So we can do our first amount. We get our first working. We say that loan repayment. We need to get the figure of the loan repayment. Loan repayment, less interest on loan, less interest on loans, less interest on loans. So we say that loan repayment is a non-allowable expense, but the interest that accrues from a loan is allowable. So if we had a figure of 8 million, we need to less minus 1.1. So this figure of 6.9, which is loan repayment, the figure of 6.9, which is loan repayment, that should be non-allowable. So non-allowable, we need to add it back to adjust it to get the taxable profit. Then the next, we're being told that a lease charge was 3 million, out of which 600,000 was in respect to drafting a 10-year lease agreement. So when you talk about a 10-year lease agreement, when you're drafting, renewing or drafting a lease that is less than 99, then that should be allowable. So the figure is allowable expense, so we do not need to adjust it. The next is what we call preliminary expenses. In respect to the trust formation was 3.4. Expenses that are incurred before the inceptions of the trust are basically an allowable expense. So the figure of 3.4, that is a non-allowable expense. The figure of 3.4 is a non-allowable expense. Then we have additional information number 2. The trading period was before taking into the consideration of the capital expenditure. One thing that we need to understand, that when you talk about the capital expenditure, when we talk about capital expenditure, we need to claim what we call investment allowance. In taxation, we do not have an expense called depreciation, but in place of depreciation, we claim what we call investment allowance. So being told that we have assets, we have a warehouse, we need to understand that warehouse qualify for an investment allowance called IBD, industrial building deduction, that we claim at the rate of 10%, that we claim at the rate of 10%, at the rate of 10%. But mark this, he said from 1st April 2022. I know this is a lot of time based on the present rate. We need to not to apportion. Initially, we used to apportion wear and tear and the IBD, but don't apportion. Claim the whole amount. For that warehouse, we have a figure of 3.5. So we claim 10% of the 3.5. I know if you look at some of the areas previously based on previous question, and sometimes you'll find these ones who are being apportioned, but based on the present rate, you need to claim the whole amount. Very important for learners to understand. Then you have delivery van, delivery tract. Remember that is wear and tear because that's motor vehicle at the rate of 25%. We need to claim it at the rate of 25%. At the rate of 25%. And we also claim the whole amount. We don't apportion. Previously, it was being apportioned. Then you have saloon car. Very important, you need to understand for saloon car and SUVs. We said that for saloon cars and SUV, if the value is more than 3 million, we restrict to 3 million. So we're going to claim 3 million out of that. We are going to claim 3 million out of that. That 25% of the 3 million. Then lastly, we have what we call the sports pavilion. Sports pavilion in this case, that is also IBD at the rate of 10% on the straight line. So then additional information number 3. The trustee received a gross rental income from commercial property of 120 million. That is additional taxable income, and a gross and what you call gross interest income from fixed deposit. That is an interest income that is subjected. We call it the non-qualifying interest, still subjected to further taxation. Fee paid to investment managers in charge of the rental property. We need to understand that we need to get the net, because fee paid to investment manager, that is allowable expense. We need to less it from what you call the gross rental income to get the net rental income. Then lastly, on additional information number 4, we are being told that each beneficiary is entitled to a quarter share of the net distributable income. But there's a fixed annuity. Those are contribution to the beneficiary, who in this case is Mona and Nora. So there's a fixed annuity for each beneficiary, that is Mona and Nora, each is going to get 10 million. Then we have trustee made 6 million. Trustee made 6 million to Mona and 3 million to Nora as a discretionary payment as per the agreement. That is tied to the amount that is due to the beneficiary. So we begin with our first calculation. Compute the income tax payable on trust income for the year ended 31st December 2022. So we begin it on this other part. So we begin it on that other part. So we have trustee, 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 that is for and Nora. Taxable income, taxable income for 2022. Taxable income for 2022. So we say we use the net profit method, accounting profit provided. So accounting profit provided, we have shillings here, but we can round it off to 1,000. We had a figure of 160 million. So we have it as 160, we round it off to 1,000. Then we say add back. Why are we adding back? Because this accounting profit was already provided. What do we add back? Non-allowable, allowable expenses, expenses in P and L, non-allowable expenses in P and L, comma, taxable income, not in the P and L, not in the P and L. Taxable income not in the P and L. So the first one is what we call, we say that printing and stationery, that was allowable. We don't need to adjust that. We have what we call legal fee, 6 million, out of which 1.2, 1.2 was in respect to defending trustee on illegal business. Defending, that is an allowable defending what you call trustee on what you call illegal business. So we add that back. The figure, that figure was, we round it to thousands. So if you round it to 1,000, that should be 1,200. That was 1.2. Then the next we have what we call, purchase and installation of accounting software. Before that, there's tax consultancy. We say expenses related to tax are non-allowable. Tax consultancy. 2.4, we round it to 1,000. That is 2,400. Then we have the next. Which we call purchase and installation of accounting software. That's capital expenditure. Purchase and installation of what we call accounting purchase and installation of accounting software. That should be 2 million, but we round it off to thousands. So we proceed to this at the end. So the next one we have, we're being told that trustees' salary as per the trust agreement, that is okay. Then we have what we call loan repayment. So loan repayment, interest on loan is allowable, but the loan repayment is not allowable. So we have loan repayment. So loan repayment, that was 8 million. We round it off to 1,000, then we less 1,100. Interest on loan is allowable, that should be 6,900. So then we have lease charges worth 3 million, out of which 600 was in respect to drafting a 10-year lease, that is allowable. Then we have the last one, preliminary expenses. Preliminary expenses. Expenses incurred before the formation of a trust, those should be what you call non-allowable. So we add them back. We add them back. So those are the non-allowable expenses. Unfortunately, we do not have taxable income that has not been included. So we add 1.2 plus 24 plus 2 million, rounded to 1,000, plus 6 plus 6,9 plus 6,9 plus 6,9, then plus 3,4. Giving us a total of 15,900. Then we say less allowable expenses, not in the P&L, allowable expenses not in the P&L. We have taxable, non-taxable, what you call non-taxable, taxable, operating incomes in P&L. Then you have what you call investment incomes in P&L. For the exam scenario, this is for the purpose of learners understanding what you're doing. But for an exam scenario, just say less. You don't need to write the whole thing. But for the sake of learning, we need to understand what needs to be less. We are saying allowable expenses which are essentially in the P&L, non-taxable operating incomes in P&L, and investment incomes that are in P&L. That is what we less. That is what we less. We pick our paper. And we are saying the first one that we have is investment allowance. Remember, investment allowances. We have the investment allowances. So the first one was non-allowable. The one that we had as non-allowable, that was purchase of installation of accounting software. Accounting software. Remember, that is investment allowance at the rate of 25%. So 25% times 2 times 2,000, that should be 500. That should be 500. Then we have the next, which is warehouse. So warehouse, those are buildings, IBD. That is IBD, that should be 10%. So 10%, the figure is 10% times 3,500. Initially, we used to apportion this figure based before the rate changes. We used to apportion this figure. For example, for the IBD, if it was April, we would have looked for about 9 months. So April, May, June to April to December, that should be 9 months, and say times 9 over 12. But with the present rate, we don't apportion, so we have it as 350. So when you get somewhere, it's a portion. Notice that with the changes that were effected, we don't apportion. Then we have what you call delivery truck. We have the delivery truck. Remember, these are motor vehicles again, at the rate of 25%. So 25% times 1750. 25% times 1750. 25%, 0.25 times 1750 times 1750. So that should be, we have it as 437.5. We have it as 437.5. We have the next that we call saloon car. Saloon car. Remember, this is restricted. Saloon car is restricted. If the value is more than 3 million, you restrict to 3 million. So we have, that is 25% times, and that should give us 750. That should be 750. Then lastly, we have what we call sports pavilion. Sports pavilion. So sports pavilion, that's also IBD, that should be 10%, but I have emphasized that based on the present rates, you don't apportion this figure, you claim the whole amount. Previously, these figures were being apportioned, but with the changes that were effected, you claim the whole amount. So times what you call 1.2. Remember, the figures are rounded to thousands. The figures are rounded to 1,000. So that should be 120. So these ones were less. There's not any investment income that were included. The investment that were there are treated separately. So what do we less? The total that we less. So we have 500 plus 350 plus 437.5 plus 750 plus 120. So this should be 2157.5. So the only allowable expense were investment allowance that were essentially not included in getting the accounting income, which is 160. So we have net operating incomes. So we have the 160 plus 15,900, then minus 2157.5. So that gives us a figure of 173,742.5. That gives us 173,742.5. Then you add what you call other taxable income. Add other taxable income. We proceed and have it. Add other taxable income. So we read the additional information. Number 3, trustee received a gross rental income from commercial property. So other taxable income, we have the gross rental income. Gross rental income. So that should be a figure, that was 120 million, so that we have 120 at that. Then we also have what we call gross interest from fixed deposit. Gross interest from what we call from the fixed deposit. So if it was net, we get the gross. So that is a figure of 20 million. So we have 20,000, rounded to thousands. Then you're being told lastly that fees paid to investment manager in charge of the rental. We need to less that fee paid. That should be to get that fee paid. Fee paid to investment managers in charge of rentals, in charge of what you call the rental. So we less that figure. That is a figure of 12 million. So we have it as 1,000. So what is the net operating income? Net operating income, we had a figure of 173,742.5. Then you had plus 120,000 plus 20, then minus the 12. So this should be, this is a figure of, we have total taxable income, total taxable income. So we have the total taxable income, that is 301,742.5. That is what you have as the total taxable income. But if you look keenly to that question, Income tax payable. After getting that, we get the income tax payable. The income tax payable. The income tax payable. So the income tax payable, we say that the taxed at the rate. So tax payable, we have it at the rate of 30%. Tax payable, we have the tax payable. Tax payable in this case, we have 30% times 301, 742.5. We round it now to the whole figure. So we multiply by 1,000, so that is 500. So that is 301 million. The essence of this is, remember, we're rounding to 1,000. So when I come here, use the whole figure, that will basically be 301,742,500. We get 30% of that. So 301, 742,500 times 0.3. So what do we have? We have a figure of 90, 9522, 750. Then we less what? We less tax credit. Tax credit. So the tax credit is on gross interest from fixed deposit, withholding from what you call interest on fixed deposit. So the key thing is not the answer, but the key thing is a learner being able to understand that what is being checked there is the ability to understand that we tax them at 30%. So we get that. So the gross dividend, that was 15% times 20 million. So 15% of 20 million, 0.15. So that should be around a figure of 3 million. So we have the net tax payable. So the net tax payable. So we have 90,522. So that should be 87. So that is the net taxable for the trustee. That is how we sort part one of that particular question. So very important, just a recap of what we did, that one of the most important things as we do these questions is to focus. The focus is essentially on the entries that emanate from these particular questions. So at the end of the day, we got the tax payable. So we move to what we call compute the amount due to beneficiary for the year ended December 2022. So we say amount due to beneficiaries. 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 So we have Mona. One of the beneficiaries, Mona, Nora, and we have the totals here. Remember, we round these figures to thousands so that we don't have a huge figure. We round those figures to thousands. So we look at additional information. Number 4, each beneficiary is entitled to a quarter of the net distributable income. We need to get that net distributable income. So we have a fixed annuity to each beneficiary. So we have the first one is fixed. What is distributable fixed? What we call fixed annuity. Fixed annuity for each. That was 10 million, so we're rounding it to thousands. That is 10, so that should be 20. We have 20. Then we have the next, we have discretion of payments. Trustee made 6 million to Mona and 3 million to Nora as discretion of payment. So we have discretional payment. So for Nora, that was 6 million. So this should be 9. So then we get what we call the net distributable distributable income. So net distributable income. What we call the net distributable income. We have the net distributable income. So being told that the net distributable income, each beneficiary is entitled to a quarter share of the net distributable income. So what is the total taxable income? The total was 301,742.5 minus, to get the net distributable, that is 20, then minus 9,000 in order to get that net distributable. So we're saying to get the total taxable income was 301,742,500. So that when you less the fixed annuity and the discretion of payment, we get what we call the net distributable income. So on that net distributable income, the examiner tells us that each beneficiary is entitled to a quarter share of the net distributable income. So we get the net distributable income, then we get a quarter for each. So that is 742.5 minus 20 minus 9,000. So that is 272,742.5. Then we multiply a quarter, we get a quarter. Each was entitled to a quarter. So a quarter of that, that should be 68. That should be 68. We have 68. 185.63. So 68, 185.63. The total for that. We have the total for the two. The total for the two times. So that should be about 136. 136. 371.25. So the total amount due. Total amount due to each person. Total amount that is due to each person. Total amount that is due to each person. So we have just have it as it is. So total amount due to each. So that is 10 plus 6 plus 68, 185.625. So that should be 84, 185.625. This should be 81. That is for Mona. Mona. We have it there, sorry. Mona and Nora. So we have 81, 185.6. So that should be 165. So that is the amount that is due to each. That is amount that is essentially due to each beneficiary, which is Mona and Nora, the figure that they get. So that is how we essentially get the part 2, the amount that is actually due to the beneficiary. So that marks the end of that question. We pick it on our next illustration.
Most welcome learners to our lesson today. We are looking at public sector governance, policy and administration. In our lesson today, we are going to focus on administrative processes as part of administrative theory. In an organization, administrative processes comprise those particular tasks which are associated with the office that are required to ensure that an organization is operating efficiently. And when it comes to the area of public administration, there are certain generic administrative processes that we want to look at. Then we have a look at the scope of public administration. Then we see what Luther Gulick brought out as the acronym of public administration in terms of its scope, and ultimately we will have a look at the importance of public administration. So when we look at administrative processes, as we have indicated, administrative processes are the office tasks, that are required to keep an organization operating. These particular office staff or office processes will be associated with receiving information, processing information, storing information, retrieving information, among other things that make a bureaucracy or an office administration run. And when specifically it comes to public administration has certain generic administrative functions and or processes which it has to go through to ensure that objectives are realized as set out. And one of the functions are policy making. And when it comes to policy making, these ones are the frameworks that are put in place to be able to achieve certain ends. Then you have organizing, which is in relation to grouping functions that are related together, ensuring that they are connected properly and they are staffed adequately, as we shall be seeing. Then when it comes to financing, this is the supporting the activities that have been planned and have been organized to ensure that revenue and resources are available to be able to finance them or to be able to meet the costs associated with those functions. Then personnel provision and utilization. This has to do with attracting, recruiting, selecting, and retaining the appropriate human resources that can be able to be tasked with the responsibility of a realization of the public administrative tasks or duties. Then when it comes to determination of work procedures, this has to do with making a decision in terms of the work that has to be realized or who is supposed to be deployed in those areas, what kind of processes are involved in terms of the field, in terms of the office, and ultimately the sixth generic administrative function or process in public administration is control, to ensure that things are on course in relation to what an organization intends to achieve. So these six generic administrative processes or functions, which are 1, policy making, 2, organizing, 3, financing, 4, personnel provision and utilization, 5, determination of work procedures, 6, control. Then give us what is referred to as the scope of public administration. So when we look at the scope of public administration, scope of public administration, scope of public administration. One of the authors or thinkers in the area of public administration by the name Luther Gulick, came up with an acronym, and this acronym has been used to capture or to sum up the scope of public administration. So Luther Gulick brought out an acronym, and this acronym is postcob, and each letter in this acronym stands for a given word, so that you have each letter, and then there's the two here. You have a P, which stands for planning. Then you have O, which stands for organizing. Then you have S, which stands for staffing. Then you have D, which stands for directing. CO stands for coordinating. R stands for reporting. And B stands for budgeting. So those terms that were given by that term that was given by Luther Gulick gives us a summary or captures the scope of public administration. So we can have a look at this briefly. So when you talk about planning, so planning is concerned with the determination of alternative courses of action. Determination of alternative courses of action for the future. So a plan is focusing at a future date that you are planning to be able to do, to maybe create a branch. You are planning to be able to create a unit, a section. You are planning to offer a particular service. You are planning to do a vaccination. You are planning to do voter registration, for example, at a future date. So that's where in public administration the term planning comes in. And when it comes to O, O stands for organizing. And by the word organizing, this one refers to the process of grouping related activities and creating a hierarchy within a given organization. So this one is concerned with establishing a hierarchy and grouping related activities for performance. So if you have an organization and this organization is looking at creating an industry, is looking at maybe starting a dam, creating an irrigation, for example, scheme, then you may want to organize and see you require engineers, you require technical staff, you require general staff, manual workers. So you create an organizational structure, and within this particular organizational structure, you create a hierarchy which has various steps, various sections, various departments. So you group them, and that is one way of ensuring that once you have now grouped them that way, you can now be able to move to the next step, which is now staffing. You have created an organizational structure, and now you require to get the staff or the human resources to be able to be deployed in that particular hierarchy or in that particular organization. So staffing is the process of identifying suitable personnel. Identify suitable personnel, selecting them, and appointing. And once they have been appointed, they are deployed and utilized to perform tasks. So that is the process of staffing. So you identify the individuals, you select them, you appoint them, you deploy them, and then you make use of them, and you also maintain them. So that stands for the S. Then after the S, you have the D, which is now directing. So this is the process of providing instructions instructions for tasks to be performed. So you are now directing and giving instructions for tasks to be performed based on the institutional or organizational requirements. So this stands for the D. Then you have the CEO, which is coordinating. So this is ensuring that things or activities are being done or implemented as expected. Coordinating, liaising with one department, with another department, ensuring that facilities, equipments are provided, and so on. Then you have R, which is reporting. So this is where the executive or officer provides feedback or information to a superior. So this is providing feedback that this was supposed to be done, and this is how far this has gone. And once that reporting is done, appropriate action may be taken. The information may be noted, or an intervention measure may be taken into consideration. Then you have budgeting. Now this is involved with the physical planning, accounting, and accountability. So this post-COB acronym, or this post-COB sum of a word, was given by Luther Gulick, and it summarizes the scope of public administration in relation to planning, organizing, staffing, directing, coordinating, reporting, and budgeting as the scope that captures what an organization does in relation to public administration. So that, Lana, is very clear to capture, so that you can be able to go through this process and observe in working environments in relation to what organizations are doing in terms of public administration. So we may want now to move to the importance of public administration. Importance of public administration. We want to look at the importance of public administration in the context of a contemporary society. In the context of a contemporary society, the importance of public administration includes, when we talk about a contemporary society, this is a society which is changing. This is a society which is progressive. This is a society that is dynamic, and this is a society where the citizens of that particular society or the people who live in that particular society are focused in making their lives better and making changes and using the resources they have prudently as per the principles of public administration. So one of the reasons why public administration is important in a contemporary society is that public administration preserves preservation of the polity. One, preservation of the polity. And when we talk about polity here, we are referring to a set of rules or the constitution. Like in a country like Kenya, we have a constitution and we have instruments that govern the state. And when it comes to the public administration, it aspires to be able to preserve the set of rules that are expected to govern the Kenyans in that context. Then secondly, public administration helps in the maintenance of stability and order. Maintenance of stability and order. We saw when we were looking at the definition of public administration, according to Woodrow requires that an organization observes the rule of law. And if an organization is observing the rule of law, part of what it does is to ensure that the judiciary, the executive, and the legislature are working and order is maintained and stability in a given environment or a given country. Then the next thing that public administration does is institutionalization of socio-economic change. Institutionalization of socio-economic change. An organization, a country is looking forward to ensuring that there are structures that can be able to ensure the society, the economic conditions in that particular society or country is good, and it's maintained to ensure that individuals are operating in a society where you have institutions that stand for particular socio-economic issues that ensure a good quality of life. Then when it comes to the importance of public administration in a contemporary society, it also helps in the management of large-scale commercial services. Management of large-scale commercial services or enterprises. Like if you are having, for example, railway networks, road network systems, or you are talking about harbors or ports which require large-scale economic investments, then the public administration processes now manage those ports, manage airports, manage hospitals at the referral level, provide services like power, among others. So those are some of the things where the areas where public administration becomes important to manage large-scale commercial services or enterprises to ensure that they are readily available, especially where the commercial or private sector organizations may not be able to manage those particular kind of entities. Then ensuring growth and economic development, ensuring growth and economic development. So the public administration also looks at the micro and macro economic activities to ensure that an organization or a country grows and it attains economic development to guarantee the individuals in that particular economy and its neighbors a good standard of living. Then there is also the aspect of protection of the weaker sections of society. Protection of the weaker sections of society. You have, for example, heard in the Kenyan context where you are talking about vulnerable members of the society. Vulnerable members of society. And in these vulnerable members, you have seen, for example, widows. You have seen, for example, orphans. You have seen, for example, the aged. So an organization, a country, through its public administration, is able to come up with intervention measures to ensure that the vulnerable or weaker members of the society are protected for the survival of the society. Then there is also the element of formulation of public opinion. Formulation of public opinion. So the public administration processes help in the formulation of public opinion. For example, many countries are going through this pandemic that has hit the whole globe, COVID-19. So the public administrators are expected to create and formulate a public opinion in terms of how this pandemic can be handled, in terms of how even with this downturn of economic events, how the country can still move on within those particular arrangements and so on. Then the public administration also helps in influencing public policies and political trends. Influencing public policies, policy and political trends. So public administration also is useful in influencing public policy and political trends that a country could be going through. So dear learner, we have looked at the importance of public administration. We have also looked at the scope of public administration, and we have also looked at the office administrative processes, where we have indicated that administrative processes are those office tasks that are required to keep an organization operating. And we have looked at the generic administrative processes or functions of public administration, where we have listed the 6: 1, public policy making; 2, organizing; 3, financing; 4, personnel provision and utilization; 5, determination of work processes, procedures; and then 6, controlling. Those ones are the generic public administration functions or processes. Then we have looked at the scope of public administration in the context of the summary word or acronym POSTCOB that was given by Luther Gulick, where we have seen that this scope of public administration comprises of planning, which is the determination of alternative courses of action for the future; then organizing, which is the establishing of a hierarchy and grouping related activities for performance; then staffing, which is the process of identifying suitable personnel, selecting them and appointing them, deploying them and utilizing them to perform tasks; then directing, which is the provision of instructions for tasks to be performed; then coordinating, which is ensuring that things or activities are being done or implemented as expected; then reporting. This is where the executive or officer provides feedback or information to a superior; then budgeting, which is associated with the physical planning, accounting, and accountability. Then we looked at the importance of public administration, and we have indicated that in a progressive or in a contemporary country, public administration is important because of, 1, preservation of the polity, which is a set of rules or the constitution of a given country. 2, maintenance of stability and order. 3, institutionalization of socio-economic change. Then 4, management of large-scale commercial services or enterprises. Then the 5th reason why public administration is important is ensuring growth and economic development. 6, protection of weaker sections of the society or vulnerable members of the society. Then 7, formulation of public opinion. Then 8, influencing public policy and political trends that are being experienced at any given time in the context of a given country where the public administration is being used. So before we finish our lesson, Lana, you have an assignment, and your assignment is Your assignment, dear Lana, is discuss the importance of public administration in a contemporary society. We have come to the end of our lesson. Thank you very much for being active.
Greetings, candidates. Welcome to the study of the subject leadership and management. And in my hand, I have the Kasneb syllabus that was released in 2021. 2021 Kasneb revised syllabus for paper number 13, leadership and management. This paper was renamed from strategy, governance and ethics. And in our today's lesson, I'm going to do an adumbration of this subject. The unit description is as follows. The syllabus reads that this paper is intended to equip the candidate with knowledge, skills, and attitudes that will enable him or her to apply and demonstrate leadership and management skills to grow an enterprise under various circumstances and environments, including under uncertainties. That is the main objective of studying leadership and management. It is to equip the candidate with knowledge, skills, and attitudes that will go a long way to enable the candidate apply and demonstrate leadership and management skills in order to grow an enterprise under various circumstances, various environments, including uncertain environments. The syllabus also lists 5 learning outcomes. A candidate who passes this paper should be able to, number 1, demonstrate an understanding of leadership techniques and management principles. Leadership techniques and management principles. Number 2, apply knowledge of leadership and management theories in organizations. Number 3, effectively undertake management functions. Number 4, make rational management decisions in an organizational context. Then lastly, embrace and manage strategic change. These are 5 learning outcomes. Now, candidates, the content is organized in 12 topics. 12 topics. The first one is Introduction to Management. Number 2, Evolution and Development of Management Thought. Number 3, Leading as a Function of Management. Number 4, Other Functions of Management. Number 5, Environmental Analysis. Number 6, Leadership Approaches and Strategy. Number 7, Decision Making. 8, enterprise management. 9, project management. 10, marketing management. 11, leadership and strategic change. Then lastly, case studies in leadership and management. Case studies in leadership and management. These are 12 topics. 12 topics, and candidates will be covering each topic at a time. Each topic at a time. For example, the first topic, introduction to management, we will study the nature of management, importance of management, levels of management, multidisciplinary nature of management, roles of management as advocated by Henry Mitzbach, the changing roles of managers and management, qualities of an effective manager, management and administration. These are the subtopics under the first topics. Then in topic 2, there are 3 categories of evolution and development of management thought. Is organized in 3 subsections. Number 1 is the classical approaches to management. Number 2, behavioral management approach. Then modern management theories. The third topic, leading as a function of management, will study differences between management and leadership. We'll study attributes and skills of a good leader. We look at the delegation, responsibility, and accountability. Then we will cover power, authority, and accountability. In topic number 4, which is known as other functions of management, we will discuss the planning function, the organizing function, the staffing function, and the controlling function. Topic number 5, which is environmental analysis, we are expected to cover microenvironment, macroenvironment, internal environment, external environment, and tools of environmental analysis. Then in topic number 6, leadership approaches and strategy, we look at the leadership traits, leadership styles, leadership skills, formulation of an organization's strategic direction, differences between transactional leadership and transformational leadership, conflict resolution mechanisms, then ethics in leadership. In topic number 7, we'll discuss the importance of decision-making models, types of decisions, decision-making process, problem-solving skills, decision-making under different conditions, challenges in decision-making, effective, and lastly, effective decision-making. In topic number 8, we are expected to study the meaning and concept of entrepreneurship, entrepreneur development, enhancing creativity and innovation in organizations, methods of generating ideas, introduction to business plan, protection of intellectual properties. That is the last subtopic in the study of enterprise management, protection of intellectual properties. In topic number 9, candidates are expected to cover number 1, project management concepts. Number 2, characteristics of a project. Number 3, importance of projects. Number 4, features of projects and baseline surveys. Number 5, illustration of the project life cycle. Number 6, project planning and organizing. Number 7, project resources and costing. Then lastly, number 8, project completion and evaluation. In topic number 10, known as marketing management, we will discuss the meaning and importance of marketing. We will look at the marketing management orientation and or philosophies. We study the marketing mix. We'll discuss the development of marketing information. Number 5 is the marketing strategies. Then we have marketing research and intelligence. And lastly, international marketing and e-commerce. Topic number 11, leadership and strategic change. We will consider the meaning of change, theories of change, types of organizational change, managing resistance to change, the organizing the change context, levers for strategic change, methods of introducing strategic change, problems of formal change programs, leading change is the last subtopic under leadership and strategic change. Then lastly, there is a case studies in leadership and management. Case studies, we will discuss or look at different case studies in leadership and management. So candidates, these are the areas that you are expected to study in your endeavor to gain knowledge, skills, and attitudes that will enable you to apply and demonstrate leadership and management skills to grow an enterprise. And that should be done under various circumstances. You're expected to manage an enterprise under various circumstances and environments, including uncertain environments. So I hope, candidates, you will be joining us in all the lessons. We are going to cover each and every aspect of this syllabus. It is expected that as we go through this syllabus, when you join these classes, make sure you take down notes. If you have questions, you are free to post your questions. Below this syllabus, there is a comment section where you can ask questions. Make sure you also practice active recall. Carry out continuous revision. Over and above the video lectures, we have also developed the study materials, study texts, and revision books based on the revised syllabus that was promulgated in the year 2021. The books are updated and they cover all these areas that we've mentioned. So make sure you study ahead. Study ahead. Always study ahead. Make sure you familiarize yourself with the various aspects of the syllabus, and as we progress with this coverage of this syllabus, make sure you always go back, answer questions, past paper questions, because some of the topics in leadership and management were retained, because I remember I said that this subject, leadership and management, was just renamed. In the old syllabus, the paper was known as strategy, governance, and ethics. There are certain topics that were maintained, like the first one, introduction to management. There is a topic on evolution and development of management thought. Other functions of management were also retained, like the planning function. We covered it in the previous syllabus, organizing function, the staffing function, controlling function, and even leadership approaches and strategy. These are some of the topics that were retained in this current syllabus. All right. The only new topics that were introduced here I can see is enterprise management. Some subtopics are enterprise management. Project management is also a new topic, including marketing management. Though candidates in the old syllabus, when some of us were studying this course, we studied project management and marketing management. These topics have been reintroduced in the syllabus. So you can see, candidates, we have past paper questions from these areas that I've mentioned. So as we progress, make sure you revise, look at the past paper questions from our revision partners. Check our revision partner. We have past paper questions with solutions. So as we progress with the coverage of this syllabus, make sure you carry out continuous revision. Don't wait at the last minute in order to revise. No. Continue
revising. For example, when you are done with topic number 1, go to the revision books, look at the questions that have been tested in the past under this topic, because in the revision books, we have organized the questions topically. So it's very easy for you to locate questions based on the topic that have been that we are covering in the subject leadership and management. So candidates, thank you for choosing to study with the Manifesto Publishers. We endeavor, we plan, we are ready to help you gain the required skills, the required attitudes and knowledge that will enable you meet the objectives that I read here. Remember, by the end of this training, number 1, the syllabus states that you should be able to demonstrate an understanding of leadership techniques and management principles. Number 2, you should be able to apply knowledge of leadership and management theories in organizations. Number 3, you are expected to effectively undertake management functions. Number 4, a student or candidate who passes this paper should be able to make rational management decisions in an organizational context. Then lastly, you are expected to embrace and manage strategic change. It's not just about knowing the principles or memorizing a few concepts. No, at the end of the training, it is envisaged that you should embrace and manage strategic change among the other objectives that I have read. So that is our intention. That is our purpose, to equip you with the knowledge, with skills and attitudes that will enable you to apply and demonstrate leadership and management skills that will enable you to grow an enterprise under various environments or circumstances, including environments and circumstances that are uncertain. So you can see, candidates, the training is not limited to you passing the exam. The skills that you gain here should enable you to demonstrate, to practice, to manage, to apply, to embrace, to make rational management decisions in an organizational context. So thank you one more time, and hope to see you as we continue studying leadership and management. Bye-bye.
We proceed to the illustration on computation of VAT, that is August 2024, question 5C. We read the question. Explain the term reverse charge, that is basically already given on notes. Then you go to 2. The following information related to lesser. The following information related to lesser limited, a company engaged in supply of taxable goods for the month of May 2024. The company was registered for VAT on 1st May 2024. So we have inventory in trade as at 1st May 2024, valued at 813,000. So we, on the opening stock, we can claim input VAT. So the second, we are being told that the company purchased goods on credit. The company purchased goods on credit and cash worth on credit. So credit is 4,750,000, and on cash is a figure of 2,980,000 respectively. So when you talk about purchase and the opening stock, those are basically input VAT. Those are VAT on purchases and expenses. So goods purchased on cash worth 180, goods purchased on cash worth 180, worth 180 did not have supporting fiscal receipt. So when you have these goods purchased on cash, we can do our working. Purchased on cash, goods purchased on goods purchased, we say purchased on cash. So basically these goods purchased on cash did not have supporting documents. So those cash, we had a figure of 2 million. We had a figure of 2,980,000. We less the ones that did not have documentation. That's a figure of 180. A figure of 180. We pick our calculator. We basically have 2,980,980 minus 180,000 minus 180,000. So we have a figure of 2.8. 2.8. This is where we are going to claim input VAT. The ones that do not have the documentation, a figure of 180, we cannot basically claim input VAT on them. So then we proceed to additional information number 3. The company sold goods worth. The company sold goods worth 8,768,000 during the month. During the month of May, the company basically sold goods worth 8,768,000 during the month. These goods included exempt sales of exempt sales worth 3,670,000 and export to South Africa, which was 1.5. So we can get the standard rate sales. So we have our working two. We are getting the standard rate sales. Standard rate sales. So it tells us the total sales is basically what we have as 8,768,000. 8,768,000. We less the exempt, which is 3,670,000. This is basically exempt, and exempt, that is 3,670,000. Then we less the zero rated. Zero rated in this case is about a figure of 1.5. Zero rated is a figure of 1.5. So we get the standard rate. We get the standard rate. So for the standard rate, we pick that, and we will say 8,768,000 minus 3,670,000 minus 1.5. So we have the standard rate sales to be 3,598,000. 3,598,000. An explanation on that. So we know that standard rate, those are taxable, and the zero rates are also taxable or vatable. But zero rate, we know we claim VAT at 0%. Exempt rate, exempt sales, we do not charge VAT at all. But we're saying that these figures on sales are basically what we call output VAT. And I've explained that exempt, we don't charge VAT, not chargeable to VAT. Zero rate, import, export is zero rated. Then standard rate, we charge VAT at a standard rate of 16%. So then we're being told that the company received a credit note. A company received a credit note and a debit note worth 600,000 and 540,000 respectively. So if I just indicate here, just to indicate working 3, we say that a credit not received, remember this, credit not received affect purchases, affects purchases. We know that this basically affect the purchases. This basically affect the purchases, and credit note will reduce the purchases. That will definitely reduce the purchases. Then the second, we have debit note. Debit note received. Debit note received. Received. That also affects purchases. And we know that debit note is used to correct an undercharge. So this definitely will increase purchases. This will increase the purchases. That is analysis for that. That definitely will increase what you call purchases. So then we are being told that during the month, the company purchased a motor vehicle on hire purchase at shillings 4.5 million to be used in business. The cash price was 3.8. If you have the hire purchase and the cash price, we basically use the cash price to claim input VAT. So the input VAT will be on the 3.8 and not 4.5 So we proceed to the additional information number 6. Additional information number 6. The company imported goods valued. 2.4, that is cost, insurance, and freight. They incurred clearing. They incurred what you call the clearing. They incurred the clearing. The company incurred the clearing and transport of for 50,000 and 150 respectively. Respectively, this import was not included in purchases above. The import duty rate during the year was 25%. The import duty rate was basically 25%. So we go to working for on import. Remember, when you talk about import, we say that import basically has a cascading effect, meaning that we charge VAT after charging import duty. So import duty is charged. Import duty is charged on what you call the CFI, cost, insurance, and freight. So we have the cost, insurance, and freight to be a figure of 2.4. So 2.4 to get the import duty 25%. So we get 25%, we can get the 25% and add, or we just have plus 125 over 100. Instead of getting 25, then we get 2.4, 125 over 100, meaning the figure plus the import duty. We can test that with our calculator. So we have that 2.4. The figure is 2.4 times 125 over 100. So the figure is basically 3 million. But you know that imports are exclusive of VAT. Imports are exclusive of VAT. Imports are basically exclusive of VAT. And when you look at the figure for the transport and clearing, those are also input, but we're going to charge them. Those are basically input. VAT. So we proceed to 7. Additional information number 7. So the company incurred the following expenses. Expenses are basically input VAT. So the first expense is what we call legal expense. Legal expense is vatable. We charge input VAT. Salaries and wages are exempted from VAT. Office rent, that is chargeable to VAT. That's we claim an input VAT. Then we have water from the county. Water from the county, that is basically exempted from VAT. Water from the county, that should not be charged to VAT. Then we have electricity, that is chargeable to VAT. Then we say 8. The company could not identify. We're being told that the company could not identify a goods sold as exempt when they purchase, and therefore restricted deductible input VAT. So we have restriction in that. Then the last additional information That is additional information number 9. Transactions are inclusive of VAT at a standard rate of 16%. So when you're told transactions inclusive of VAT, transactions inclusive of VAT. So means that VAT is already charged. So we say into bracket use 16 over 116. Use 16 over 116. If the transactions are inclusive of VAT, it means that VAT is already charged on that. So we basically use 16 over 116. So we proceed to what is required. Determine the value added tax payable or refundable to lesser limited for the month of May. So we can say VAT payable or refundable to lesser. We say to lesser limited, payable or refundable to lesser limited. Particularly on questions that we have restriction, one of the best approach to take, especially on questions that you have on restriction, is basically to do the output separate and do the input separate. Sometimes students mix them, but the best approach to take when it comes to questions that basically deals with the restriction is to have the output separate, and also do the input separate. So we go to the output, we get the output VAT. So on the output VAT, we have standard rate. We have amount here, then we have the VAT rate, then we have the VAT. So we have item on that. So the first item is standard rate cells. And the standard rate cells, we had done the figure as we rotate the camera. As we rotate the figure for the standard rate, we less the exempt and zero rated. We had the figure of 3,598,000 times 16. Transactions are inclusive of VAT. So we have our calculator, and 3,598,598, then times 16 over 116. So the figure that we have for that should be a figure of 496,276. That is for the standard rate cells, a figure of 496,276. The next items on cells, we have what we call zero rated, zero export. And when you read the additional information number 3, export to South Africa. So export was a figure of 1.5. Remember zero. There's zero rated. So that is zero. That is zero on that. Then you have exempt. Exempt, we have add a figure of 3,670,000. We don't charge VAT at all. So then down here we have what we call total output VAT. Total output VAT. That should be a figure of 496,276. 496,276. We proceed to the input VAT. We get the input VAT. We proceed to what we call input VAT. We have what we call input VAT. So on the input VAT, we have item on this. Item, amount. We have the VAT rate. Then finally we have the VAT. And we move sequentially. So the first item that we had was credit sales, credit purchases. We charge VAT on the credit purchases. So credit purchases, a figure of 4,750,000. The VAT rate, because it's inclusive, 16 over 116. So we pick our calculator And we have that. We pick our calculator. So we basically, as we pick our calculator, we know that 4,750,000 times 16 over 116. So we have, on that we have a figure of 655. 655 to all number, that should be 172. 655, 172. We proceed to what we call the cash. We call it cash purchases. So on the cash purchases, there is a working basically on the cash purchases. There's a working on the cash purchases. We say that some of the purchases did not have physical document. So the working basically will list 180. So for the cash purchases is a figure of 2.8. 2.8. So we have the 2.8 at this point. Then we multiply by the rate which is 16 over 116. We get the figure on that. So we have 2.8 times 16 over 116. So that should be about a figure of 386, 207, 386,207, 386,207, to rounding it to all number. We proceed to the next. We had what we call credit note received. That's the reduction of purchase. So we have credit note received, credit note received. We had a credit note received. So on the credit note received, the company received credit note and debit note. So credit note received was a figure of 600,000. That is additional information number 4. So credit note basically reduces the purchases. So times 16 over 116. So what do we get when you have that? So 600,000 times 16 over 116. So that should be about a figure of 82, 759. 82,759. Then debit note received. That is used basically to correct an undercharge. An undercharge that should increase the purchases. So we have a figure of 540, a figure of 540, 16 over 116. A figure of 540, 16 over 116. So 540 times 16 over 116. So the figure that you have, that should be about 74, 483. 74, 483. 483, 74, 483 as the figure, 74, 483 as the figure. Then there was an entry that was not basically added, opening inventory. So we had the first entry on opening inventory. On the first month, you can claim that opening inventory. Opening inventory. So the opening inventory was, we had a figure of 813 times 16 over 116, the opening inventory. 813 times 16 over 116. So that should be a figure of 112, 130, 112, 138 as the figure. 112, 138 as the figure. So we proceed to the next. We had, during the month, the company purchased motor vehicle on hire purchase. We use the cash price. Motor vehicle. We have the motor vehicle. So motor vehicle is basically a figure of, we use the cash, which is 3.8, 16 over 116. 16 over 116. So we have the 3.8, 3.8 times 116 over 116. So that should be about a figure of 524. That should be a figure of about 524. 524, 138. 524, 138. 524, 138. The next item was basically on import. We know that import, we have done the working. As we rotate the camera, import, we basically are done the working. Import plus import duty, we have a figure of 3 million. And you know that import are normally exclusive. Even if the question is inclusive, they're normally exclusive. So we have import. Import, a figure of 3 million. 3 million. Then that 3 million we have times 16 over 116. Times 16 over 116. So 3 million, 16 over 100, sorry, because that is exclusive. So that's 3 million times 16 over 100. So that should be definitely about 480. 480. That should be 480. Then you have those transport. We have the transport. Remember, those are the point of entry. So those are basically inclusive. Transport cost, clearing. We have clearing. We have clearing cost. So clearing cost and transport clearing is 450. So for 50,000 times 16 over 116. 16 over 116. So we're having 450 times 16 over 116 for the clearing. So the figure should be 62. 62,069. 62,069. Then we have the transport. Transport is a figure of 150. 16 over 116 for the transport. So transport should be 150. 150 times 16 over 116. So we have a figure of 20,690. That should be a figure of 690 for that. So then we proceed to the additional information. We have legal. Legal, we said legal are not exempted. Legal, we have the legal expenses. So legal expenses, which we claim VAT. So that should be 350. 350. 16 over 116. 16 over 116. 16 over 116. So 350. 350. 350 times 16 over 116. So the figure for the legal, that should be 48. We have 48 to 76. 48 to 76. 48 to 76. Then you have the next, salaries are exempted. You know, salaries and wages, salary and wages. We know that salaries and wages, these are basically exempted. So the figure was 133400. We know that these are exempted. Then we have office rent. Office rent. We claim input VAT. That should be 580. 580. 16 over 116 for that. 16 over 116. So we have a figure of 580 times 16 over 116. That should be about 8,000 for that. Then the next we have what we call, we don't even to put it there. That is water from the county, that is basically exempted. Then we have electricity. We can have the electricity. Electricity. Electricity is a figure of 54, inclusive of VAT 16 over 116. 16 over 116. So electricity is 54. 54 times 16 over 116. So the figure should be, that should be 7448. So that was 655, 172 plus 386, 386, 207, 386, 386, 207, 207, 207, then minus 82, 82, 759, so start again, 655, 172 plus 386, 207, then minus 82, 759, then plus 74, 483. 74, 483 plus 112, 138, 112, 138, then plus 524, 524, 138, then plus 480,000, for 80,000 plus 62, 62, 069, 069 plus 20, 690 plus 80, plus 80,000, then plus 7448. When you add that, that provides total. We have a total input VAT, total input VAT of 2,367,000. 2,367,862. 2,367,862. 2,367,862. Look back at our statement. That is statement 8. The company could not identify goods sold as exempt when they were purchased and therefore restricted deductible input VAT. So there is restriction. So we need to restrict input VAT. So how do you restrict input VAT? We say that taxable supplies over what we call total supplies times total input VAT. So we say that taxable supplies is equals to standard rate plus zero rate. Standard rate plus zero rate. Then you say that total supplies is standard rate plus zero rate plus exempt. And when we are restricting NB, when restricting standard rate sells should be, say should be exclusive of VAT. When restricting, the standard rate sales should be exclusive of VAT. So we have a figure of the standard rate. Sales, the figure for the standard rate sales. This is a figure of 3,598,000. Remember, this figure was inclusive of VAT. So that implies that the figure is 116%. We make that figure exclusive. Exclusive is 100%. So 100%, basically we say 100% over 116 times 3,598,000. So exclusive standard rate exclusive of VAT. So we have that figure. So we have our calculator. That should be 100 divided by 116. Then we multiply by 3,598,000. So we have a figure of 3 million. We round it off. 101, 724. 724 as what we call the standard rate exclusive of VAT. So we can get taxable supplies. So we can get taxable supply, which is zero rated plus zero rated taxable supply, zero rated plus standard rate. Taxable supply should be 3,101,724 plus 1.5, which is zero rated plus 1.5. So that gives us total taxable supplies to be, so plus 1.5. Plus 1.5, we have a figure of 4,601,724. 724. Then you can have total supplies. Total supplies, we say that should be a standard rate, which is 3,101,724 plus zero rate, which is 1.5, plus zero rate, which is 1.5, plus the exempt. Exempt is a figure, if you look at that paper, on additional information number 3 is a figure of 3,670. 3,670. So we get the figure. Then plus 3,670. So that should be 8 million. Total supply should be 8 million to 8 million. 8,271,271, 8,271,271, 8,271,724. So we restrict. At that point we restrict. At that point now we can restrict. At that point. We have our formula for restriction. Taxable supplies. Taxable supplies is 4,601,724 over what you have as 8,271,724. Then times total input VAT, which is 2,367,820, 862. So that is deductible or restricted deductible input VAT. The input VAT, deductible input VAT. So we have a figure of 4,601,724 divided by 8,271,724. So the figure is 0.55 times 2,367,367 862. 862, having a figure of 1,317,289. 1,317,289. So then we can get VAT payable or refundable. VAT payable, stroke refundable, stroke refundable, stroke refundable. That should be output VAT minus deductible, what you call the deductible input VAT minus the deductible input VAT. So we have the output VAT still here. That should be 496,276 minus 1,317,289. So we have, this is basically a refund. So when you say VAT payable, then you put it into bracket. But when you say VAT refund, this is basically VAT refund, VAT refund, VAT refund, VAT refund, VAT refund. So that should be a figure of 821,013. When you say VAT payable, when you say VAT payable, that should be into negative. That should be that. So that is how we particularly. But maybe just an emphasis on how an approach is very important. When you look at these values, remember what is of key is the entries. These are entries that are being marked. For exempt may not be marked. When you have this these figures are the ones that basically constitute the solution. The most important part is those figures, understanding those figures. That is what basically would provide us with the solution. So as a learner, very important to understand is that to follow the procedure. You may not understand a few points here and there, but as long as you are doing your entries perfectly well, you can have about, let's say, 80% to 100% of the entries, you are in a good direction. So the key thing is to understand those entries and make sure that you make as many entries as possible. And when we do that, we will perfectly be handling those questions pertaining to the administration of VAT. That marks the end of our session. We meet in our next session.
Hello learner, welcome to Manifested e-learning platform. My name is F.A. Emlin Ngwiri. And ladies and gentlemen, we are discussing about advanced portfolio management with a focus on capital market focus. We are talking about the application framework of capital market focus. So to dive a mile deep, we are discussing about application of economic growth and trend analysis. So we are going to discuss about financial equilibrium models there. So financial equilibrium models. Equilibrium models. There. And we mentioned the following, that financial equilibrium models assumes that supply and demand in global asset markets are in balance. They are in balance. Proceed on and say, in turn, financial models will value sensitivity, correctly, or security securities, pardon me, not sensitivity, will value securities correctly. Because we talk about valuation of securities, not of sensitivity. Securities value securities correctly. So what are we saying? Under financial equilibrium models, it assumes that supply and demand in global asset markets are in balance or are considered to be in equilibrium. Therefore, in turn, saying financial models will value securities correctly. One model is the International Capital Asset Pricing Model, ladies and gentlemen. So we can say that one model is the International Capital Asset Pricing Model. International Capital Asset Pricing Model, which we can say is ICAPM, International Capital Asset Pricing Model. So how does the model look? So International Capital Asset Pricing Model, of course it's a return computing model or return computation model, is given as RF plus RM minus RF beta. So RF, risk-free rate of interest, RM, return on the market. Then we have beta. Beta is considered to be systematic risk. Systematic risk there. And so we can build on this model over here by saying the following over here. Let's move over on this other side, that we have the correlation. So we know the formula for correlation. Correlation is given as covariance of IM all over what, ladies and gentlemen? Remind me, all over what? All over standard deviation of I, standard deviation of the market. Standard deviation of the security, standard deviation of the market there. That is what you're saying is given as the correlation. We can then cross multiply. So correlation is given as, or between IM, is given as standard deviation of I, standard deviation of M. Pardon me for that, because we're cross multiplying. So this should be a component of that over there. So we're saying that this is what I need to remove to correct that. Standard deviation of I, standard deviation of M is equals to covariance IM. So once we have the covariance given to us over there, we can then proceed on and mention something inclined towards the beta. Because we talk about financial equilibrium models. So beta has to be considered. This element over here of beta. So beta is given as what? This component of systematic risk is given, based on equilibrium models, is given as covariance of IM over variance of the market. Variance is standard deviation squared. So where there is covariance, we can replace it with correlation, standard deviation I, standard deviation M, based on that model over here. So this one, this model over here comes into play. So we're saying what? We're saying that the beta, or rather beta, is given as covariance. Beta is given as correlation. We're just replacing this wherever covariance is. Correlation, standard deviation of I, standard deviation of M, all over standard deviation squared of M. We have standard deviation of M, standard deviation of M over here. So that one and that one go. Therefore, we have the beta being given as correlation, standard deviation of I, all over standard deviation of M. That. So once we have this, ladies and gentlemen, we can then proceed and say that the correlation component over here, correlation, or how do we get correlation once we talk about financial equilibrium models. We move over on this other side over here, and we can say that RM, or rather on rearrangement. Remember, our focus, ladies and gentlemen, is on this one here, this international capital asset pricing model over here, right now over here, ladies and gentlemen. So you can highlight it and what our focus is on. This is what our focus is on, ladies and gentlemen, there. So on rearrangement, we can have RI, which represents the international capital asset pricing model, is given as the risk-free rate plus R, return on the market, minus risk-free rate, and then we have beta I. But we already know on this other side, ladies and gentlemen, if you come on this side, please, we can see that beta is given as correlation between I and M, standard deviation of I over standard deviation of M. So we replace it wherever beta is, like that. But before we replace it, let's take this RF on this other side. So RI minus RF is equals to RM minus RF beta I. So we can say let RI minus RF be RP. Let RI minus RF be R, you can say RP. So this one, so RP is given as beta I RM minus RF, like that. Now this beta is where we replace it with whatever value we've actually discussed over there. So RP is given as now the beta, and we have correlation, and we have times standard deviation of I over standard deviation of M, like that. Then we multiply that with this, of course, we RM minus RF, RM minus RF, that. So we allow this RM to come on this other, because there's a multiplication sign right here, guys. So we can have RP is given as correlation standard deviation of I, and then we multiply by RM minus RF all over standard deviation of M over here, like that. And once we have that, we are saying that this value represents the Sharpe ratio. RM minus RF over standard deviation of the market represents the Sharpe ratio. And RM minus RF represents the market risk premium right there. So we can say that, therefore, that RM minus RF is given as the market risk premium. Market risk premium. And RM minus RF over standard deviation of the market is given as what we can say the Sharpe ratio. This is the Sharpe ratio. Sharpe ratio. Like that. So having discussed that, ladies and gentlemen, we can then move on and look at a question. A question is what I want to discuss right now. So the question reads as follows. Given the following data, calculate the equity and debt risk premiums for country X. Given the following data, calculate the equity and debt risk premiums for country X. So you can see country X bonds have been provided, and country X equities have been provided. As far as expected standard deviation, correlation with the bond investable markets have also been given. The market Sharpe ratio is also being given. What we need to understand based on that diagram is that the final expression which we're saying is the market risk premium, which we've already looked at for an asset, is equal to the correlation with the global market portfolio multiplied by the standard deviation of the asset multiplied by the Sharpe ratio there. I repeat, final expression that we've just looked at based on that example you're seeing there for an asset is equal to the correlation with the global market portfolio multiplied by the standard deviation of the asset multiplied by the Sharpe ratio of the global portfolio. So let's work it out together there. Work it out on this side here. So, because we've been told to calculate the debt and risk and equity risk premium, so RP solution, RP bonds is given as, we're just going to get the expected standard deviation, 10%, multiplied by the market Sharpe ratio, 0.35, as we've just said, multiplied by the correlation with the global investable market, 0.4. And the same thing, RP for equities is given as, we say you're just going to get 15% multiplied by 0.35. That is the market Sharpe ratio. Then we multiply that by the correlation component of 0.7. How much do we get in both cases? So it's the first case, it's 0.1 multiplied or 10% multiplied by 0.35 multiplied by 0.4. You were saying we're getting 1.4%. How about the second case? We're getting 15 multiplied by 0.35 multiplied by 0.7. 3.675, or it's 3.68. 3.68%. Well, that is a fairly straightforward, ladies and gentlemen. It shouldn't be able to actually give us any component of I. And this is what we're saying right here, guys. The RP, the return for equities and the return for bonds, ladies and gentlemen, is given as we multiply the correlation, and that's exactly what we've done, the correlation component with the standard deviation there with the market risk premium. That's what we're just doing, ladies and gentlemen, there. Not too difficult for us, at least because we are saying that both of us, we are analysts and we know the secret, and other individuals don't know the secret, guys. So these three, you just multiply them like that. So another thing that probably perhaps would be interesting to note is that if we have the correlation right over here, so if the correlation over here, ladies and gentlemen, the correlation right over here, and we have correlation is equals to 1 like that, ladies and gentlemen, that signifies a very important component there. We are saying that the ERP, or equity risk premium, is equal to, and the equity risk premium, you remember, we are saying the equity risk premium represents return on the market minus risk-free rate over there. So ERPM divided by a very key component, guys, over here. We're dividing the ERPM by the standard deviation of the market. That is if correlation is equals to 1. And we're saying that I'll obviously need to highlight this in blue, the opposite color, so that we can be able to take note of that. That is if correlation is equals to 1 and ERP is equals to ERPM over standard deviation of the market there. Why are we saying that? We can come back on this other side, ladies and gentlemen. This side is what we're saying. So we are saying that the correlation is 1. If correlation is 1, like just multiplying 1 times this component over here. So we'll get the ERP, market risk premium, is that one. We divide by standard deviation of the market over here, standard deviation of the market. And that's what we've done right over here. That is when the correlation is given to us as 1 there. So we are saying that we will then have to look at an example over here based on our previous lesson over here, ladies and gentlemen. So the example reads as follows. Typical Kasneb example is like this one here. Using market risk premiums to calculate expected returns, betas, and covariances there. Suppose an analyst is valuing 2 equity markets. Market A is a developed market and market B is an emerging market. The investor's time horizon is 5 years. The other pertinent facts are, number 1, Sharpe ratio of the global investable portfolio is 0.29. The standard deviation of the global investable portfolio is 9%. The risk-free rate of return is 5%. Degree of market integration for market A is 80%. Degree of market integration for market B is 65%. Standard deviation of market A is 17%. Standard deviation of market B is 28%. Correlation of market A with the global investable portfolio is 0.82. Correlation of market B with the global investable portfolio is 0.63. Estimated illiquidity premium for A is 0%. Estimated illiquidity premium for B is 2.3%. Calculate the assets expected returns, betas, and covariance there. So the first thing that we need to do, ladies and gentlemen, is we need to calculate the equity premiums for both markets, assuming full integration. Full integration means that all available information is with with all individuals there. So we're saying that not all markets may actually be fully integrated or segmented. What we need to note is that if a market is considered to be to estimate the size or liquidity premium, one could estimate the multi-period Sharpe ratio, ladies and gentlemen, there. And if markets are segmented, ladies and gentlemen, what you need to note, if markets are segmented, then 2 assets with the same risk can have different expected returns because capital cannot flow into those markets with relative ease. So we just dive right in then. The question. ERP, so solution. So we are first of all calculating, we need to first of all calculate the equity risk premium. So ERPI is given as correlation multiplied by standard deviation multiplied by the Sharpe ratio. I've already explained that on the further end there. The correlation times the standard deviation times the Sharpe ratio. So now we do for ERPA. ERP for market A there. And we can see the correlation is 0.82 multiplied by 0.17, which is the standard deviation for market A, multiplied by the Sharpe ratio. Sharpe ratio is 0.29 right there. How much do we get for that? And we are saying that it's going to be 0.82 multiplied by 0.17 multiplied by 0.29. 0.04, or we can be able to say is 4.04%. 4.04%. Now, for ERPB, we need to add an estimated illiquidity premium for market B. Notice one thing, guys. The illiquidity component for market A, we were supposed to have added it onto this. But you see, there is no illiquidity. We're saying the illiquidity component is 0. given that information. So I'm referring you back to the to that table or that information that we've actually been given. So that information indicates that estimated liquidity premium is 0%. So we would have added over here 0%. How about for ERPB? So if you had illiquidity component, we would have considered that over here. So ERPB is going to be given as the correlation. The correlation is 0.63 multiplied by the standard deviation. Standard deviation of B, we're saying is 0.28 to 8 multiplied by the Sharpe ratio. The Sharpe ratio is the same, 0.29. Then we add now the illiquidity component over there, 2.3% over there. So how much do we get in this? So we are getting 0.63 multiplied by 0.28 multiplied by 0.29 equals, and then we add 0.023. We're getting 0.074, 0.0742. 7.42%. Like that. So now we've computed the equity risk premium for A, equity risk premium for B. We need to factor in or to determine whether the market is either at integration or segmentation there. Next, we need to calculate the equity risk premium for both markets. Equity risk premium for both markets, we do it in the middle over here. Equity risk premium for both markets. So based on the information given to us there, the ERP, ERP I is given as, we know the standard deviation is equals to the standard deviation of I multiplied by the market Sharpe ratio, multiplied by the Sharpe ratio. So ERPA, remember what you're doing, ladies and gentlemen, over here. Based on the information over here, guys, we are saying we are assuming full segmentation. So maybe perhaps it would be better for me to factor that element over here, full segmentation over here. Assuming full segmentation. Assuming full segmentation. I've already explained what segmentation is. Please rewind back and see what I've actually described as segmentation. And just to mention that a market is segmented, two assets with the same risk can have different expected returns. Two assets with the same risk have got different expected returns because capital cannot actually flow relatively easy within those markets over there based on the higher asset return. So now assuming full segmentation over there, we need to now consider the equity risk premium there. So we are saying ERPI is given as standard deviation of I times times multiplied by we talk about market Sharpe ratio. So ERPA here, we are going to get the standard deviation, which you're saying is 0.17 multiplied by, we already have the figure over here given to us of the 0.17 multiplied by the market Sharpe ratio 0.29, and ERPB is given as 0.28 multiplied by 0.29, right there, 0.28 multiplied by 0.29, and we are going to add that liquidity component over here. Sorry, I almost forgot that. Plus the liquidity, the illiquidity component, and you're saying is 2.3%. 2.3%. How much do we get in both cases, ladies and gentlemen? So we have 0.17 multiplied by 0.29, 4.93%. And 0.28 multiplied by 0.29 plus 0.023. We're saying you're getting 0.1042, or 10.42% there. So what we need to note, ladies and gentlemen, please note one thing, that we or when we are able to calculate, ladies and gentlemen, when you are able to calculate the risk premium under full segmentation, we use the local market as a reference market instead of the global market. We use the local market as a reference point as opposed to using the global market. So the correlation, ladies and gentlemen, in this question over here, you can see the correlation between the local market and itself is 1. Local market in itself is given as 1. When we are fully integrated, ladies and gentlemen, and segmented, risk premiums by the degree of integration or segmentation in each market to arrive at the weighted average equity risk premium. So the equity risk premium can be calculated based on the degree of integration multiplied by the ERP assuming full integration plus the degree of segmentation multiplied by the equity risk premium assuming full segmentation there. So what are we saying? So ERPA, we are going to, or ERP general formula first, ERP I is the degree of integration times equity risk premium of integration. So degree of integration multiplied by ERP or equity risk premium assuming full integration, ERP assuming full integration, that then we add now the same, so it's degree of integration times expected ERP assuming full integration plus degree of segmentation multiplied by ERP assuming full segmentation. That. So integration, free flow of capital. Segmentation, there is no free flow of capital, and I've already explained what that means. So on this other side, we have already computed, we have the degree of integration given to us. So you can see degree of integration which have been given as 0.8. So ERPA is equals to 0.8 multiplied 0.8 multiplied by 0.404. This is the answer we are going to multiply against over here, guys. Once we move over here, this is what our focus is on right here. So 0.0404 plus 1 minus this, which we're saying is the degree of segmentation now. So 1 minus 0.8 multiplied by now the component of segmentation. I believe it is 4.93 right there. 0.0493. That. ERPB is given as the same. We get 0.65 multiplied by this value over here, 7.42, guys. You can see it here. So 7.42, 0.0742 plus 1 minus 0.65 multiplied by not 4.93 but 10.42%. 10.42 rather 0.1042. yeah, so we can close the brackets like that. So how much do we get in both cases there? So I'm just working it out right here. 0.8 times 0.0404 plus 0.0493. 4.22%. I hope you're getting that. 4.22% for that one. For B, we're saying we have that 0.65 times 0.0742. That's 1 minus 0.65. 8.47%. 8.47%. So I need to highlight those ones in different color. That. Once we have that, guys, then how do we compute the expected return? The expected return in each market figures is the risk-free rate. Since we've already calculated the equity risk premium, we need to add now that so that we can be able to get the expected return in each market. Remember, ladies and gentlemen, the ICAPM talks about RF plus RM minus RF multiplied by the beta. And we already broke this one down over here, and we've already calculated this segment right over here. So that needs to we need to add on to the risk-free rate so that we can be able to get the return, the actual return right there. So we are saying what? We're saying that the return of A and the return of B is given as RF plus, in the first case 4.22%, and then RF plus now 8.47%. That. So which we're saying is given as the RF is 5% in both cases, 5% plus 4.22%, and then we get how much, and then we're saying this is for A and this is for B. We're saying 5% plus 8.47%, like that. So this is 9.22, looks like 9.22%, 13.47% there. So then how do we proceed on to calculate the betas in each market there? Betas in each market, So betas in each market there. Of course, we use red. So beta, we know beta is given as what, ladies and gentlemen? Covariance IM over variance of the market, standard deviation squared of the market there. So how then do we get betas for A? So beta A is covariance for IM, which you're saying is 0.82. You can see covariance is 0. We've been given the covariance. No, we don't have the covariance. You have the correlation. So then how do we get it? So we already know, ladies and gentlemen, over here what covariance is. So beta, so we need to just rewrite that formula again. So covariance, we don't have the covariance given to us there, but this can be rewritten as based on correlation. So it's correlation IM, standard deviation of I, standard deviation of the market, all over standard deviation squared of the market. Remember what we had said earlier on there. Please rewind the video and try and see how we've actually done it. So that and that goes. So we're saying is given as correlation IM, standard deviation of I, all over standard deviation of M. So now we have the correlation given to us there. So you can do for A, beta for A, because we have the correlation. So the correlation is 0.82, yes, 0.82 multiplied by standard deviation of 17%, or rather 17, all over standard deviation of the market. Standard deviation of the market is 9. That how much do we get? And beta of B is given as how much do we have? We're getting 0.63 multiplied by the standard deviation of I. Standard deviation of I is 28. Then we divide by standard deviation of the market, which is also the same as over here, 9. How much do we get in each case? So let's compute it together. For here, we have 0.82 multiplied by 17 equals divided by 9, we have 1.54. And then we do the same 0.63 multiplied by 28 divided by 9, 1.96, and that is the beta, measure of systematic risk. So because the question was also asking us to compute the covariance of the two equity markets, ladies and gentlemen, we can do that on this other side. So we know, over here, that covariance Ij is given as the beta of I, beta of j, based on whether the market is integrated or segmented there. Standard deviation squared of the market. And hence, we're saying we have beta for I and beta for j, and also the variance of the market. So we have 1.55 multiplied by the beta of the other market there, 1.96. You can see it from the table there. Multiplied by the variance of the market, we're saying is 9 squared. How much are we going to get for the covariance there? So times 1.96 times 1.555. I'm getting, 2.46, 2.46, or is it, let me just redo it again, because this is 9 squared is 81, 9 times 9 times 1.96 times 1.55. Yeah, 246, it makes sense. Not 2.46, 246. That is the covariance. The degree of association between variables is 246.078 right there. So we are saying that, ladies and gentlemen, this brings us to the end of this subsection. Over here, we are not through with application of economic growth and trend analysis. We shall be able to proceed on, and in our next lesson, we shall be able to discuss the use of surveys and judgment for capital market expectation. The use of surveys is also another method that analysts use in developed economies as well as even in our economy over here. So I will leave you with an assignment that you can be able to try during your free time. Over there, the assignment is as follows. Suppose an analyst is valuing two equity markets. Market Z is a developed market and market X is an emerging market. The investor's time horizon in 5 years is 5 years. The other pertinent facts are Sharpe ratio of global investable portfolio 0.29, standard deviation of the global investable portfolio 9%, risk-free rate of return 5%, degree of market integration for market A is 70%, degree of market integration for market B is 60%, standard deviation of the market A 17%, standard deviation of market B is 28%, correlation of market A with the global investable portfolio 0.82, correlation of market B with global investable portfolio 0.6, estimated illiquidity premium for market A is 0%, estimated illiquidity premium for market B is 2.3%. I initially mentioned X and Y. So suppose market A is a developed market. And calculate the assets expected returns, betas, and covariance. Thank you for being with Manifested Publishers, and bye-bye.
Greetings to you all and welcome to the lesson. The subject is business and data analytics. We've been studying the first topic, Introduction to Data Analytics. So far we've done the CRISP, which is an acronym for the Cross-Industry Standard Processing for Data Mining Framework. Under that subtopic, we discussed the data concepts, the conceptual concept, logical concept, physical, and also physical data models. We went through the stages in data life cycle. Then in the second subtopic, we've begun looking at big data and data analytics. We, in our last lesson, defined big data. In our today's session, we're going to describe the 5 V's of big data. The 5 V's of big data. And to remind you, candidates, big data, as the name suggests, is data that is very large. Big data is defined as very large data sets having large, varied, and complex structure, with difficulties of storing, analyzing, and visualizing for further processes or results. So big data is a combination of the unstructured data, the semi-structured data, and the structured data. All right? Big data is a combination of data that is unstructured, semi-structured, and structured. Unstructured, semi-structured, and structured. Do you understand? And big data can be mined to gain insights, leading to predictive modeling and other advanced analytics applications. Big data can also be used to improve operations. Big data can be used to provide customer service. Big data can be used to create personalized marketing campaigns. And all that increases value. Okay? And as an example, big data can provide companies with valuable insights into their customers that can then be used to refine marketing techniques to increase customer engagement and conversion rates. And organizations that use big data have a potential competitive advantage over those that don't have, since they make faster and more informed business decisions as provided by the data. So in our today's lesson, we are going to describe the 5 V's of big data. So by the end of the lesson, you should be able to describe the 5 V's of big data. And these V's also help us to understand characteristics of big data. The V's are: 1, volume. 2, variety. 3, velocity. 4, veracity. 5, value. Value. 5 V's. 1 V, 2, 3, 4, 5 V's. The first one is volume. Volume refers to the quantity of data. Volume refers to the quantity of data. It refers to the amount of data that exists. And volume is like the base of big data, as it is the initial size and amount of data that a company can collect. And if the volume is large enough, it can be considered big data. But we know what is considered to be big data is relative. What is big data to company A may be small data to company B. And may also change depending on the available computing power that is on the market. So volume refers to the quantity of data. Number 2, variety. Variety, on the other hand, refers to data types. Refers to data types. Because we have diverse types of data, we have diversity of data types. An organization may obtain data from a number of different data sources, which may vary in value. Data can be obtained from outside an enterprise, or data can be obtained from within the enterprise. We saw earlier we have unstructured data, which we know is data that is unorganized and comes in different files or formats, such as texts, audio data, we have video format, log files, and so on. We have data that is semi-structured. This is data that may not have been properly organized into specialized repository, but it may have associated information. And it makes it easier to process it as compared to the unstructured data. But structured data, meanwhile, is data that has been organized into formatted repository, meaning that such data is made more addressable for effective data processing and analysis. So there are various data types depending on data that is received from different sources. Data may be in form of text, it may be verbal, it may be written, it may be in video format, data may be in audio format, data may be obtained from without the organization, data can be obtained from within the organization. So this is a characteristic of big data. And I've said data that is structured is easier to process and analyze such data as compared to data that is unstructured. Then thirdly, we have velocity as the third V of big data. Velocity. Now, velocity refers to the time that is taken to process and analyze data. It refers to how quickly data is generated and how quickly data moves from point A to point B. And velocity is an important aspect for companies that need data to move quickly. There may be need to have quick data flow so that such data is available at the right time to make the best business decisions possible. And an organization that uses big data will have large and continuous flow of data that is being created and sent to different destinations. All right? Big data being generated quickly. Big data being processed quickly or sent to different destinations for processing. And we say that data could flow from sources such as machines, such as networks, such as smartphones. Data can flow from sources such as social media. And such data needs to be digested and analyzed quickly. And at times, such data ought to be analyzed real time. And I can also say that it may be better to have limited set of collected data than to collect more data that an organization can handle. Why? Because that can lead to slower data velocities. For what is the point of having big data that is not analyzed or that is not processed? So it's rather you have a limited amount of data that can be processed, that can be digested, that can be quickly analyzed, if possible real time, because at times information may be required, decisions may be required to be made real time. Therefore, data has to be made available for making such decisions. Velocity refers to how quickly data is generated and how quickly data is moved or flows from point A to point B. The fourth V is veracity. Veracity. Veracity refers to the accuracy of data. The accuracy of data. The correctness of data. The quality of data that is gathered. So gathered data could have sometimes missing pieces. Data gathered could also be inaccurate. And it may also not be able to provide real valuable insight. So veracity refers to the level of trust that a leader has in the collected data. Because sometimes data can be messy. Data can be messy, data can be difficult to use. And large amount of data can cause more confusion than insights, especially if such data is not complete. So veracity refers to accuracy, refers to the quality, refers to the trust that the leader has in the information that is gathered. The correctness of data. So data that has missing, that is not accurate, that is data that cannot be relied upon in making decisions. So veracity is a very important feature of big data. Then we have value. Value. Value refers to the value that big data can provide, the added value that big data can provide, and it relates directly to what organizations can do with the collected data. Because big data is only relevant or important if it has value. Being able to pull value from big data is a requirement. As the value of big data increases significantly depending on the insights that can be gained from them. So it's not enough to have big data. It's not enough to just gather data and have data. The question is such data valuable to the organization? And organizations can use the same big data tools to gather and analyze the data, but how they derive value from that data should be unique to them. All right? So here data refers to the quality of data. The value, this we said refers to the quality of data. This is value added. Veracity refers to the quality of data. The quality of data. The accuracy of data. So, candidates, these are the 5 V's of big data. 5 V's of big data. The first V, volume. Volume. The second V, variety. The third V, velocity. The fourth V, veracity. Then lastly, value. We've said volume refers to the quantity, the amount of data. Variety refers to the data types, which could be unstructured, semi-structured, or structured. We say that data comes in different types, could be in different formats: audio format, text format, video format, log files, and so on. Velocity refers to the time that the organization takes to generate big data and to process or analyze big data. Veracity, on the other hand, refers to the accuracy or quality of big data. Veracity. Then lastly, value, which we've said refers to the value that big data can provide. We've said that it relates directly to what organizations can do with the data that is collected. We said collecting data is not enough. What is important is what value do you derive from the data that has been collected? And that brings the lesson to an end. The objective of this lesson was that by the end of this lesson, you, the learner, should be able to describe the 5 V's of big data, and that will form the basis of our today's assignment. Describe the 5 V's of big data. Thank you for attending this lesson. I hope to meet you in our next lesson. We'll continue to share knowledge in business and data analytics. Thank you. God bless you. Bye.
Welcome to Manifested Publishers.
Hello learner, welcome to Manifested e-learning platform. My name is F.A. Emlyn Ngwiri and we are discussing about portfolio management. The focus of today's class is on introduction to portfolio risk and return. So what we're going to do, we're going to narrow down that discussion to assess the determinants of required rates of return. Now the determinants of required rates of return can be broken down into 3. The first determinant of rate of return is the time value of money. The second determinant of the rate of return is expected level of inflation. The third and final determinant of required rate of return is the risk itself. So we are going to break down or try to understand how those factors influence the required rate of return and also investment decisions for investors. So we move over on this other side and start off our class. We mentioned that investors' required rate of return, investors' required rate of return, investors' required rate of return is one of the factors to consider, is one of the factors to consider when selecting securities for an investment portfolio. Securities for an investment portfolio. Continue and say, it is the minimum required rate of return that an investor would actually require so that they can be compensated for deferring the usage of funds today. So we say that it is the minimum. It is the minimum rate of return. Rate of return is the minimum rate of return an investor should accept. An investor should accept minimum rate of return that an investor should accept from an investment in order from an investment in order to compensate them for deferring consumption. From deferring consumption. So let's just recap what we've just written. Investors' required rate of return is one of the factors to consider when selecting securities for an investment portfolio. It is the minimum rate of return an investor should accept from an investment in order to compensate them from deferring consumption. So now since we've already now explained or introduced what the investor's required rate of return is all about, we now start by assessing the components. The first component that I had mentioned to you, number one, is time value of money. Time value of money. That's the first determinant that an investor should consider before investing or making an investment decision. So we say that the value of the sum of money at a future date that has been invested at a certain rate, certain rate of compound interest, certain rate of compound interest over a certain period of time, a certain period of time. We'll stop. Let's stop there. We are saying that TVM, time value of money, is the value of the sum of money at a future date that has been invested at a certain rate of compound interest over a certain period of time. A shilling today is not what it was a shilling, say, 10 years ago. So that is that concept of time value of money. Very important determinant for required rates of return. Investors therefore prefer to receive money more sooner than later. Why? Because investors can reinvest those funds or those proceeds they've actually received at a different at a different rate of return. So we can say that investors, we move on this other side, prefer to receive money sooner rather than later. The reason being is that receiving money sooner can allow them to reinvest at prevailing rates of return so that they can be able to earn inflows as opposed to waiting to earn it much later on. The second determinant of required rate of return, very important, is number two, expected inflation. Expected inflation. This is the rise and fall of the level of purchasing power, or the purchasing power, whether it actually increases or decreases. When inflation levels actually go down, or when the inflation is, say, manageable or slightly low, it means that what you can buy with 100 shillings or 1,000 shillings is going to be much more as compared to when the inflation levels are actually high. This is an important factor to consider. How much money you'll actually receive. Will it have a higher purchasing power or will it have a lower purchasing power? So we say that the rise and fall of inflation, must be included in any calculation in order to reflect the value of the investment, the value of an investment, value of an investment at a later date, Rise in prices, a rise in prices of general price of commodities leads to lower spending power, and vice versa. So we note that the rise and fall of inflation must be included in any calculation in order to reflect the value of an investment at a later date. Nominal value, the real value. The real value factors in that element of inflation. A rise in prices of commodities leads to lower spending power. That is the second most important determinant of the required rate of return. The third one, ladies and gentlemen, is risk. 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 Risk factors, we can say, risk factors may vary. Risk factors may vary from instrument to instrument, from instrument to instrument, instrument to instrument. Risk of investing investor, so risk of investing in a venture capital firm might be high, but the expected returns from that investment need to compensate the investor for deferring the usage of funds today to replace to make an investment or that investment in that risky venture. So we can say that the risk of investing in a venture capital firm, of investing in a venture capital firm. Please note that a venture capital firm is considered to be maybe a firm that has just begun and that is actually considered to be, say, a startup, not a startup from the grass. So we're saying that it's like, so there at this level, it's moved from that level over there to this level over here, and in terms of the assets or in terms of say the size of the company has moved from that smaller level to this. So this is what we're considering a venture capital firm over here, or we can be able to say a venture capital firm is generally like considered to be a startup there. So the risk of investing in a venture capital firm is high, but returns should compensate. But returns should compensate. Returns should compensate for the higher risk taken, compensate for the risk taken. Risk taken right there. So we are saying that risk factors may vary from instrument to instrument, or from investment to investment, or from asset class to asset class. The risk of investing in a venture capital firm is high, but the returns generated from that investment should compensate for the risk taken, right there. And this brings us to the end of this subsection that we are talking about determinants of required rates of return. Three major ones, and the first one is the time value of money. The second one we've already discussed over here is the expected level of inflation, and the third one is risk. As usual, I will leave you with an assignment. So come over on this other side. Explain giving or citing examples, the determinants of required rates of return. The determinants of required rates of return. Required rates of return. That is the assignment that I have for you today. We hope you've enjoyed this class. Thank you and be blessed.
Welcome to Manifested Publishers.
So let's move to non-adjusting events. This is another type, non-adjusting events. Non-adjusting events. Non-adjusting events, these are disclosures. These are new events that did not exist prior to the audit period. These relate to conditions that arose after the audit period. These are conditions that arise after the audit period. They do not change the 2025 score, but they are so material that they must be disclosed to ensure the report is not misleading. One example could be board resignations. Say 40% of the board members have resigned. Sudden resignation of, say, 40% of the board. For example, the chair has resigned, the audit committee lead has resigned in January, immediately after the audit, or March or February. Now, while the 2025 board was stable, the 2026 board is now in a governance crisis. When you are auditing this company in 2025, the board was intact. But in February, 40% of the board members have resigned. So that is a non-adjusting event. This is an event that is arising after the audit period. It may not change the 2025 score, but is a serious matter that needs to be disclosed so that those who are relying on the 2025 report are not misled. Mergers and acquisitions. Mergers and acquisition. It is a merger or the company has acquired another company. Signing a deal to be acquired by a foreign entity 2 weeks, say, after the year 2025 audit period, that significantly changes the organization's stakeholder landscape. It is an event that did not exist in 2025, but in 2026, that is the position. We have merger or so that is another non-adjusting event. It could be major disaster. Major disasters could be a fire outbreak that demolishes the entire server room, a fire or a cyber attack in February 2026 that destroys the company's primary data center, and that tests the business continuity plan and must be disclosed as a significant risk to governance in future. It has to be disclosed. Example for new legislation. These are examples of candidates of non-adjusting event. There's a new legislation, for example, the enactment of a new law, or it could be change in a company, the Companies Act. So that did not exist in 2025, but that happens after 2025, say in February 2026. A new legislation that makes previous best practices now mandatory requirements. We are new provisions that did not exist in 2025, but because of the new law, what was regarded as best practice now becomes mandatory requirement. So that's it, candidates, for the types. We are discussing post-governance and compliance audit, the adjusting and non-adjusting events. This is just to reinforce what we did in our last session.
Hello learner, welcome to Manifested e-learning platform. My name is F.A.M. Ngwiri and I practice within the financial services industry in Kenya. Ladies and gentlemen, we are learning about advanced portfolio management. The key focus on capital market focus. We dive a mile deep and talk about the application framework. Which application framework? Capital market focus framework. And so we are going to introduce the application of economic growth trend analysis. And we can mention the following, ladies and gentlemen, that the use of tools. Which tools are these? We're saying forecasting tools, ladies and gentlemen. The use of tools helps the analyst set capital market expectations. Stop there. Formal tools are those that are accepted, or acceptable, accepted within the investment community. Within the investment community, or what we can be able to say the financial services industry, ladies and gentlemen. So we begin by talking about statistical tools. So statistical tools, because we're talking about capital market focus, and we are trying to analyze economic tools that are used to try and predict capital market expectations. So we can say something that descriptive statistics tries to summarize data, summarizes data. Inferential statistics uses data to make forecasts. Let's stop there for a bit. What are we saying? We are saying that the use of tools helps the analyst set capital market expectations. Formal tools, ladies and gentlemen, the key word there is formal tools. Formal tools are those that are accepted within the investment community, the financial services industry. So we are saying now, we are diving a mile deep by talking about statistical tools, statistical forecasting tools. Descriptive statistics summarizes data, perhaps in graphs, charts, and so on and so forth. Inferential statistics over here uses data to make forecasts there, predictive models like that. So breaking it down a bit, we can mention the following, that when trying to predict returns, within a single period, we can say a simple arithmetic average is used. An arithmetic average is used. So we are saying when trying to predict returns within a single period, an arithmetic average that is underlined, double underlined, is used. How about for multiple periods? That's when, ladies and gentlemen, we discuss about the geometric average or geometric mean. So we mentioned over here that when trying to predict returns in multiple periods, and or a geometric mean, a geometric mean is used. A geometric mean is used. So if you have returns for period 1, 2, 3, 4, and 5, like that, and we have periods, these are periods, and the returns we have maybe say x percent, Y percent, Z percent, V percent, and U percent over here. So let me just distinguish it over here, and O percent like that. We're saying under single period model like that, if you're saying that you're trying to analyze data within a single period, you get an arithmetic average over here of that period. So X percent, so we can assume that this is one complete cycle over there. Or if for purposes of maybe simplicity, maybe say you have within 1 year, you have quarter 1, quarter 2, quarter 3, and quarter 4, because this is one period like that. You get X percent, Y percent, Z percent, and V percent like that. So this is 1 year like that. And for us to use a simple, this is because it's one period, we just get an arithmetic average mean by saying you get X percent plus Y percent plus Z percent plus V percent all over 4. All over 4. It's one period. But when trying to extrapolate that into multiple periods, 1 year, 2 years, 3 years, 4 years, and 5 years, and so on and so forth like that, is when we use the geometric average, trying to come up with a predictive model. Yeah, so the geometric average now in this case is where we are going to get now the nth root over here. So in this case, it's the 5 periods. So you have the 5th root of 1 plus x, of course in percent, x percent, 1 plus x percent, like that, 1 plus y percent, z plus 1 plus z percent, and then we have 1 plus v percent, 1 plus o percent, like that, up to there, and then minus 1 there. So we first of all get this. What does it mean? It means first of all we get the nth root, in this case it's the 5th root of the product of these returns over here, and then we less 1 after we've gotten the 5th root there. So that is what we're saying, we apply a geometric average. So moving on, we are saying that another approach can be used when estimating equity returns by the use of bond yield plus risk premium. By the use of bond yield plus risk premium. Bond yield plus risk premium. So what are we saying? We're saying that another approach can be used when estimating equity returns by the use of bond yield plus risk premium. So you just get the bond yield, or the yield of, say, a 10-year bond. What is the yield? So the bond yield over here, and then we add the risk premium. Risk premium, remember, from CAPM, we're talking about RF plus RM minus RF, like that. And then we multiply that by beta y. This is a measure of systematic risk there. And this is, of course, the risk-free rate over here. And we're saying the bond yield can be representative of that component there, the risk-free rate. Then the risk premium is just the difference between the market return, ladies and gentlemen, and the risk-free return over here. So this is the equity risk premium over here. So what we're saying, that we don't include this measure of systematic risk. We're just going to get it up to that level, and then we add those two. The bond yield plus risk premium, excluding factor sensitivities, ladies and gentlemen, there. Having mentioned that, we can talk about other models there. So statistical tools, the first statistical tool, ladies and gentlemen, is the descriptive statistics over there. Graphs, charts, and so on and so forth. Inferential statistics, we are saying, uses data to try and make forecasts by coming up with models that can be able to extrapolate it into the future. or extrapolate that data into the future. Now, another approach over here is what you're saying is the bond yield plus risk premium. So I hope you're taking notes as we're discussing like that. So the bond yield plus risk premium approach is also another tool that is used to predict economic or conduct economic analysis into the future. And we're saying what? We're saying other tools include, so time series models are also used to make estimates that assume the past value of variables is at least in part, a valid estimator, of its future value, Stop there. They are used to make estimates in the near term. They are used in practice to make estimates in the near term, or what you can say in the short to medium term period there. So let's recap. Time series models, important model, are also used to make estimates that assume the past value of variables is, at least in part, a valid estimator of its future value. They are used to make estimates in the near term. So time series models, as we move along, we'll be able to try and showcase examples of how we can be able to use time series models or even statistical tools in lump sum so that we can be able to at least understand the tools used within the investment profession. So over on this other side, ladies and gentlemen, we are talking about another approach of, or another statistical tool, ladies and gentlemen. So we are saying it's volatility clustering. Volatility clustering, we can say, has been observed where either high or low volatility, tends to persist at least in the short run. Volatility clustering. So some models have actually been developed in practice by foreign bodies or foreign institutions, such as JP Morgan Chase. And we are saying that volatility clustering tries to group data that has got similar attributes and tries to use that data to try and make inferences into the future there. So what are we saying? We're saying volatility clustering has been observed where either high or low volatility tends to persist at least in the short run. Another statistical tool that is used in practice, ladies and gentlemen, is multi-factor models. So multi-factor models can be used in a top-down analysis to forecast returns based on sensitivities, returns based on sensitivities, and we are saying beta and risk factors. A two-factor model takes the form, ladies and gentlemen, y is equals to b naught plus b1 x1 plus b2 x2 plus an error term there. So these, the b naught, b1, b2, this represent factor sensitivities. This is the intercept over here, the y-intercept. When x is 0, what is the value of y? That is the intercept there. And this one represents the factor sensitivity and that relates to this factor. This factor sensitivity that relates to this factor right over here. And all these, the x1 and x2, influence y there. If it influences y, then we need to try and magnify or try and see what can be able to increase the returns right over here, or coming up with a predictive model that is useful in predicting returns into the future there. And so once we've discussed about statistical tools, descriptive statistics, inferential statistics, we've also discussed about the bond yield plus risk premium approach, the time series analysis, and also volatility clustering as well as multi-factor models. We are saying that multi-factor models can be used in a top-down analysis to forecast returns based on sensitivities, beta, and risk factors. A two-factor model is shown to you right over there. After statistical tools, our next stopping point is what we call, say, discounted, dividend discount models. Dividend discount models. So because of consistency, ladies and gentlemen, I wrote it in capitals. So here I need to also put in capital letters over here. Dividend discount models. There. So ladies and gentlemen, before we go into, actually it's supposed to be discounted cash flow models, not dividend discount models. Dividend discount models, of course, ladies and gentlemen, has been discussed in equity investment analysis, so my apologies for that. Before we move ahead from this point over here and discuss about discounted cash flow models as an alternate to try and estimate economic growth rates or to try and predict the future or conduct trend analysis, we can be able to look at an example how we can be able to apply statistical tools there. So the example is based on a two-factor model over here. And over here, of course, is an example of a two-factor model. So the question goes as follows. Tom Jones is a senior strategist examining equity and bond markets in countries C and D. He assigns the quantitative group to prepare a series of consistent calculations for the two markets. The group begins at level 1 by assuming there are two factors driving the returns for all assets, a global equity factor, that is, and a global bond factor. At level 2, this data is used to analyze each market. The data used is shown in the tables below. So you can see factor covariance matrix for global assets, that is global equity factor and global bond factors have been provided on both sides. So moving down in first column, we have global bond factor, global equity factor, global bond factor. Then the second column, we have global equity factor 0.0211, then 0.0015, that is the covariance. Then global bond factor 0.0015, that's the covariance of F1 and F2, and the variance is 0.0019. You can see it there. The second table, you have factor sensitivities for the countries. So we have countries C and D, the global equity sensitivity there and the global fixed income values for both countries C and D have also been shown to you there. So we are saying what? We are saying that you can be able to clearly see that the 0 sensitivities in table 2, as you can see there, indicate that that both markets are equity markets, ladies and gentlemen. So both markets are equity markets, and that means that the correlation between each market and the global bond market is 0, which means that once the effect of the equity market is controlled, ladies and gentlemen, for the partial correlation of each market, the global bond factor remains 0. So in trying to conduct what we're saying over here, a two-factor analysis over here, we can be able to see that the covariance C and D, so solution, right over here. So covariance CD is given as follows, ladies and gentlemen. So we are getting the beta for market C, using factor 1. Then we multiply that by the beta of market D for first factor times the variance based on factor 1. Then to that we add the beta for the beta for market C, second factor. This is the second factor, this is the first factor. First factor. So we do the same, but now for the second factor. That. Then we multiply that with beta for market D, second factor. Then we can be able to now do or conduct the variance of factor 2, like that. Plus, ladies and gentlemen, plus we have beta for C market 1, beta for market D, factor 2, plus beta C for the second factor. So we've done first factor, second factor. So we are going to do second factor, first factor, like that. So beta for C for the second factor, and then we multiply beta for D for the first factor right over there. We close the bracket because we've opened the bracket right over there, and we continue and say covariance F1, F2. I hope you've understood what we're doing. We're trying to get the covariance of market C and D. So for us to get the covariance, we are going to get, first of all, the beta for market C, the first factor, beta for market D, the first factor, variance for factor 1. Then we get the beta for market C, factor 2, beta for market D, factor 2, for market D, factor 2, and then the variance, factor 2, like that. And then we just multiply it by this component over here, the beta or the factor sensitivities for market 1, factor sensitivities for market 2 over there under factor 2, the factor sensitivities for market C under factor 2, factor sensitivities for market D under for market D factor 1, then times covariance factor 1 and factor 2 there. So putting it all together, if you allow me, I can come on this other side, ladies and gentlemen. I can come here. We are saying what? So the specifics in terms of the value. So covariance CD is given as, we're just repeating what we've just written over here, but now putting the values there. So we are putting it 0.9 multiplied by 0.8 multiplied by 0.0211 plus. So that's the first component over here. That component there. Another component there. And then there's that component there. That's the first component. And then we have 0 multiplied by 0 and multiplied by, ladies and gentlemen, 0.000019, like that. That's the second component there. And then we are adding what? Now we are adding this part over here like that. So we are adding 0.9 times 0, that part there, plus 0 times 0.8, like that. And then we multiply by the covariance of factor 1 and factor 2. Covariance of factor 1 and factor 2 from the table is given to us there, I can see as 0.0015. So how much do we get for this over here? Pick my calculator very fast. Over here, work it out. At 0.9 times 0.8 times 0.22, 0.211 plus that, 0, that's 0 plus that, 0.11 there. I'm getting 0.0152. 0.0152. That is the covariance of market C and D. Once we've gotten that, then we can proceed on to also estimate the variance for market C. How do we estimate the variance for market C? So variance for market C over there, and how we estimate the variance is given as the following formula over here. Variance is given as beta squared C market 1, then we multiply by the variance of factor 1 plus we get beta squared of C2 multiplied by variance, or variance over there of factor 2, that plus 2 beta of C1 beta of D of C2, sorry, C2, C1, C2, beta of C1, C2, and then covariance F1, F2 over there, plus what we are saying, the variance of the error term, market C. So we're dealing with market C, ladies and gentlemen. That's why we're saying we're just doing C, 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 like that. How about for D? We'll do the same, but now we'll be able to do with the values for D. So putting it all together, you can have the values as follows over here. So variance squared is equals to, valuation squared is given as, we are having 0.9 squared multiplied by 0.211, 0.211, because we're saying that this is the variance, ladies and gentlemen. This is the variance. So it's 0.0, pardon me, 0.0211 there, like that. And then we are adding, we have 0 squared multiplied by 0.0019, close the bracket over there. So we are multiplying that, like that, sorry. So 0 times that value there. And then we are saying we have 2, we are this part over here, 2, this part over here, beta C1, beta C2, covariance F1, F2 plus that value there. So 2 multiplied by 0.9 multiplied by 0 multiplied by 0.0015 over there. So how much do we get for the variance for this market here? So working it out very quickly, so I have over here, so I'm getting, ladies and gentlemen, 0.0, getting 0.0171171. That is the variance over there. But what about standard deviation? So we get standard deviation is given as 0.0171. you get the square root of that. That's what we get over there. So if you get them square root, so square root of 0.0171, we get a standard deviation of 0.13. How about variance for market D? We use the same formula, but I'm just going to now indicate, so standard deviation squared is given as beta squared for D1, standard deviation squared of factor 1, then plus beta squared of D2, factor 2, variance squared of factor 2. We're saying we have factor 2, yes, factor 2 like that. And then plus, now we are repeating the part that has got that constant 2 there. So 2 beta D1 beta D2 covariance F1 F2 plus standard deviation error term there. So putting it all together, how much do we have? So we have 0.8 squared multiplied by the variance 0.0211 there, then plus we have 0 squared there, then multiplied by of course here there's multiplication by 0.019 plus 2 times 0.8 multiplied by 0.0015 over there. So how much do we get for this value here? So very quickly, just work it out. So I'm getting 0.0135. 0.0135 like that. And having computed the variance for market C, variance for market D, we are saying that the variance for the markets will tend to be higher. As shown to your screen there, ladies and gentlemen, this is the analysis you can be able to come up with. That the variance of the markets will be higher than the estimated because the analysis has not accounted for the variance for the residual risk. That is the error term component there. Each market will have residual or idiosyncratic risk not explained by the market factor and sensitivities right there. So moving on, we now discuss about discounted cash flow models. It's the second type of model that we're discussing. So the first one we've been discussing is statistical models. So let's move ahead and discuss about discounted cash flow models. I had initially made an error and said it's a discounted cash flow, discounted dividend discount model. But now what I'm saying is discounted cash flow models. So discounted cash flow models, I'll use a different color now. So the topic, because it's a subtopic, we could talk about discounted cash flow models. And the major discounted cash flow model is, of course, derived from the discounted dividend model, the Gordon growth model, ladies and gentlemen. And the Gordon growth model over here, we are saying is what? Is just, so value is given as D naught 1 plus G all over R minus G over there. This is the required return, this is the growth rate, this is the dividends. Remember this component over here, this one E represents historical dividends. The D naught represents historical dividends. This can be rewritten as or V in the value, the intrinsic value D1 over R minus G. If we have forecasted dividends, if that part is forecasted, over here is historical. It's historical, it's D naught. So the keywords there you should be able to see is dividend just paid, current dividend, past dividends, and so on and so forth, like that. But when you have a forward-looking approach, some words that represent forecasting, or a forecasted approach, we can say it is, say, the expected dividends, future dividends, forward-looking components, so on and so forth like that. So this model, of course, can then be, when making R the subject of the formula over there, just on rearrangement of this one, not this one over here. So we're making R the subject of the formula, we are saying we should be able to have, when we make R the subject, we have the following, and we have R is given as D1 over V plus G, like that. And of course, R required return, V intrinsic value, G growth rate there, and dividends, forecasted dividends. Greenwald Cronum was an individual who took this model a little bit further. Let's see together what he actually said. So, on advancement of the Gordon growth model, Greenwald and Kroner took it further. Remember, I talked about coming up with forecasting tools. Talk about discounted cash flow models. So we have over here D1 over P naught plus I plus G minus change in S plus change in the price to earnings ratio, change in P stroke E, like that. Where this represents the dividend yield. I represents X. This is, by the way, expected. It's expected. I, expected rate of inflation. Expected inflation. Moving over on this other side, we're talking about G, real growth rate. And then we have change in S as the change in the number of shares outstanding. Change in the number of shares outstanding. That. How about the change in PE? Change in P stroke E, you are saying is a change, is percent change or percent change, like that, percent change in level of PE, percentage change in price to earnings ratio, percent change in price to earnings ratio. We can then, of course, deduce a few things, ladies and gentlemen. What can we deduce? We can just group this in what we can say in a simple form. This formula over here can actually be regrouped as follows. So in terms of the income return, we can say it's just given as D1 over P naught minus change in S. That is the component of the income return. So this part here and the change in S, of course, we're saying we're including the sign, ladies and gentlemen, represents income return. Moving on, we can say the nominal earnings growth growth. The nominal earnings growth, ladies and gentlemen, is denoted by I plus G, the nominal earnings growth. So this part here, I and the G have actually been settled and very well. Nominal earnings growth rate. And the repricing return, finally, repricing return is given as change in P stroke E. So in the exam, you could be given some inputs that can be able to assist you to come up with a predictive model based on this Greenwald-Kroner model. So this first component is called the income return. This one is called the nominal earnings growth rate, I plus G, and the repricing return is given as change in PE ratio. So ladies and gentlemen, I can give out, or we can do a question together. So the example is as follows. Suppose an analyst estimates a 2.1% dividend yield, real earnings growth of 4%, long-term inflation of 3.1%, a repurchase yield of negative 0.5%, and a PE repricing return of 0.3%. So we are saying what? We are saying that the total expected return on the market will be based on computing these three returns. So we can be able to do it together right over here. So we are saying we have the expected current yield, expected current yield. The expected current yield is given as the dividend yield plus the dividend yield plus repurchase yield. Plus repurchase yield. And so we're saying we have 2.1% plus purchase yield is being given to us there, the purchasing return, which we're saying is repurchase yield is negative 0.5%, negative 0.5% over here. So very quickly, on my calculator, yes, I'm getting 1.6%. Once we get the expected current yield, then we can move ahead, ladies and gentlemen, and compute the expected capital gains yield. Expected capital gains yield. Expected capital gains yield, as you can be able to see, is given as real growth plus inflation. Real growth plus inflation. And then over there, plus repricing. Repricing. Yeah, which is saying the real growth given to us there is 4%. Then we add 3.1%. And then we add 0.3% of the repricing, 0.3% repricing. So we are getting how much? We are getting 7.4% like that, because we're saying 4, 5, 6, 7, then 0.3 plus 1, like that, 7.4%. Once we get that, that represents, so the total expected return on the stock market, total expected return on stock market, total expected return on stock market is given as the 7.4%, 7.4%. Plus, we are saying this value of 1.6% like that. And you're saying we are getting around 7, 8, looks like 9%. 9%. That is what you're saying is total expected return on the stock market there. So we can then move on from here and discuss how we can be able to predict fixed income returns. Predicting fixed income returns. So fixed income returns. So fixed income returns. So if we were to label, of course, we talk about, first of all, the statistical tools as being A, and then we talk about discounted cash flow models as being B, and this is now what you're saying is our C, fixed income returns. And fixed income returns can be measured or can be estimated. These returns can be estimated using what we can say a discounted cash flow analysis. Discounted cash flow analysis. Discounted cash flow analysis. Discounted cash flow analysis, or the risk premium approach, as explained before. Over here, right over here, in this part over here, we are seeing the dividend discount model or discounted dividend model and the Gordon growth model, as explained before, or a risk premium approach, or using a risk premium approach. Risk premium approach. So we're saying the return is computed, the forecasting return, trying to forecast, we're trying to forecast returns. So the return is given as risk-free rate. Then, ladies and gentlemen, we add premiums. So we add what we say inflation risk premium, inflation risk premium. Then we also add what we can say default risk premium, that. And then we also add additional components for illiquidity risk premium, liquidity risk premium. And then we add what we can say maturity risk premium, maturity risk premium. And finally, ladies and gentlemen, and most important, we can be able to add tax premium plus tax risk premium. That. So what are we saying again on fixed income returns? These returns can be estimated using a discounted cash flow analysis, as explained before, or using a risk and premium approach. As explained before, we've already explained it in the previous subsection over here. And now we can also use a risk premium approach. As explained before, we are talking about the bond yield plus risk premium approach. Now here we're talking about a premium using a risk premium approach, which is a different format. So forecasted returns is given as the risk-free rate. Then we add inflation risk premium, changes in the prices of goods and services. Default risk, the rate at which default will occur in terms of fixed income instruments or corporate bonds. We're talking about illiquidity risk premium, the change in liquidity levels within the market as derived by the fixed income and the trading that occurs within fixed income airspace. Then we're also talking about maturity risk premium, and finally the tax risk premium. This maturity risk premium is based on bullet and barrel structures there. And bullet is where you concentrate payments on a specific point or maturities around the maturity date. You concentrate bonds or bonds which have got similar maturity along the maturity date. And tax risk premium, where we talk about the risk of paying higher taxes when going for infrastructure bonds vis-a-vis treasury bonds there. So this brings us to the end of this subsection where we talk about economic trend analysis. In our next lesson, still under application of economic growth rates, we build on other models that can be able to move us ahead in trying to forecast expected returns. So I will leave you with an assignment right here. The assignment I have is explain the statistical tools, discounted cash flow analysis, discounted cash flow analysis, and the, what you can say, fixed income returns analysis models, and the fixed income returns analysis, fixed income return forecasting methodologies. Forecasting methodologies. Explain the statistical tools, that's the first one we've discussed, discounted cash flow analysis, and the fixed income return forecasting methodologies. Thank you for being with Manifested Publishers. Bye-bye.
Greetings, candidates, and welcome back to the lesson. The subject is meetings, compliance, and administration. We're continuing with the topic on governance, standards, and guidelines. So far, we've covered guideline standard number 001, 002, 003, 004, 005, 006. Today, we move to governance standard number 7, GS 007. This is filing annual returns. Filing annual returns is our today's focus. That is governance standard number 007. And this is the standard that ensures that public record of a company is kept current. It is done what? It is kept current. Because while many mistakes an annual return for say tax returns, the GS 007 focuses on statutory compliance. Many mistake an annual return for tax returns, but GS 007 focuses on statutory compliance. That means confirming that the company's structural details, like directors, shareholders, and their addresses with the government register, are accurate. So GS 007 is a standard that mandates that an organization provides a periodic health check to the registrar of companies, and that is to ensure transparency for the public, for the creditors, and for the investors. You understand? Yes. So do not mistake annual returns for tax returns. Here we are not discussing tax returns. We are discussing filing annual returns. All right? The standard focuses on compliance, statutory compliance, because the law mandates companies to make certain returns. So what is an annual return? If an annual return is not a tax return, then what is an annual return in the context of governance standards? Now, an annual return, candidates, is a statutory document that summarizes the company's legal structure as of a specific date. Let me define it. An annual return is a statutory document. Statutory document. First of all, it is a statutory document. An annual return is a statutory document that does what? That summarizes the company's legal structure. That summarizes the company's legal structure as at a certain date. All right? That summarizes the company's legal structure as of a specific date. As of a specific date. As of a specific date. That is the meaning of a statutory annual return in a snapshot. In a snapshot. That is the meaning. It is a statutory document that summarizes the company's legal structure as of a specific date. It is not a financial report, but a confirmation of, say, registered office. It's a confirmation of the company's registered office. It's a confirmation of the company's registered office. This is the physical and postal address of the company. It is also a confirmation of the company's officers. It is a confirmation of the company's officers. This is the current list of directors and the corporate secretary. It is a confirmation of the company's share capital. It is a confirmation of the company's share capital. That is the total number of shares issued and their value. It is also a confirmation of the company's shareholders. It is a confirmation of the company's shareholders. These are the owners of the company, names of members, and any share transfers that occurred during that year. It shows the list of shareholders and any transfers that were made during that specific year. Understand? Yes. It also confirms the company's indebtedness. It confirms the company's indebtedness. It details any mortgages or charges secured against the company's assets. Mortgages or charges secured against the company's assets. Indebtedness. You understand? So that is an annual return. Because you recall in our previous sessions, we covered the documents, the statutory documents, the statutory documents, the statutory paper, the statutory documents, registered office, companies' offices, companies' officers, the share capital, the shareholders. So an annual return, it is not a financial report. Neither is it a tax return, but it is a statutory document that confirms or summarizes the legal structure of a company as at a specific date. It confirms the company's registered office, the company's officers, the company's share capital, the shareholders, and indebtedness. Now let's discuss the deadlines and timing. Deadlines and timing. This is number one. Number two, deadlines and timing of filing annual returns. Okay, so in analyzing the deadline and timing, we are going to have the milestone and the requirement. Let's have the milestone and another column for requirement. Milestone and requirement. We begin with the return date. Return date. The return date. This is usually the anniversary of the company's incorporation. These documents or confirmation must be done during the anniversary of the company's incorporation. The requirement is usually the anniversary of the company's incorporation. The company's incorporation is the birthday of a company. It is the day the company is born. So after the first anniversary, after the first year of incorporation of a company, then the company has to file annual return. Then there is the filing window. Filing window. There is a window within which the filing has to be made. And most jurisdictions require the return to be lodged within 20 to 42 days of the return date. 28 to 42 days. 28 to 42 days of the return date. That is 42 days or 28 days after the return date. The return date is exactly 1 year after the incorporation of the company. Understand? So filing has to be done by 42 days. Okay? Within 42 days, not more than 42 days. And it could be after 28 days, between 28 and 42 days after the anniversary. So it could be first anniversary, second anniversary, third anniversary, and so on. So that if a company was incorporated on 1st January 2024, the first anniversary would be 1st January 2025. So the filing date, the filing window, there is a window. It's supposed to be between 28th of January, then not more than 42 days after 28th day of January 2025. That is the filing window for a company that is incorporated on 1st January 2024. That is the filing window. Then another milestone is the AGM link. AGM. The AGM link. In many jurisdictions, the return is made up to a date shortly after the annual general meeting. That is General Standard number 001, annual general meeting. The return is made up to a date shortly after the annual general meeting. The date shortly after the annual general meeting, because general meetings are also held annually. That's why they are called AGM. This A stands for annual. So shortly after the AGM, these returns are supposed to be filed. Understand? Yes. So that is the deadline and timing of filing annual return. The GS 007 also has what we call a compliance check. To fulfill this standard, there are steps that must be undertaken. So what is the compliance check? So this is number 3. Number 3, compliance check. There are steps that must be followed when filing the annual returns. To fulfill the GS007, there are steps that must be undertaken. The first step is verification. Number 1, verification. Verification. This is to ensure that information in the return matches the internal statutory records. Because what is filed is just information in the statutory records. If the company is to confirm the registered office, then the name of the registered office in the return should be the name in the register or in the name in the statutory records. So what is filed here is what is contained in the statutory records. So there has to be verification. What is contained in the annual return should be what appears in the statutory records. That is what we are calling verification. And that is the work of the company secretary. Company secretary should ensure that the information in the return matches the internal statutory registers that we covered in our last session, that is GS006, registers and records. Because what is being filed is confirmation of what appears in the records and files. You understand? Yes. Number 2, after verification, there is certification. After verifying, then there has to be certification. The return must typically be signed by at least one director and the company's secretary. Then, of course, there is the aspect of financial statements. The financial statements. What do we mean? For many companies, there ought to be a certified copy of the audited financial statement, which must be attached to the return. In some countries, in some regions. Then the 4th item on the compliance checklist. This is a compliance checklist. Is payment. Lodgement is only considered complete once the statutory filing fees is paid. So that's very important. And candidates, here we are discussing statutory matters. What we are discussing here, these are requirements of the law, and there are consequences of non-compliance. If the company does not comply, if the company does not file annual returns, then there are consequences of non-compliance. Consequences. Let's discuss the consequences of non-compliance. Consequences of non-compliance. Because these are statutory responsibilities, then the company that does not comply then faces certain consequences. Because GS007 is heavily enforced because the registrar relies on this data for public transparency. The registrar of companies relies on the data that is provided under GS007 for the purposes of transparency. And failure to file results may lead to automatic fines. This can lead to automatic fines. Automatic fines. The company may be fined for non-compliance. The company can be fined for non-compliance. There could be daily penalties that accumulate until the return is filed. Understand? Yes. Number 2, dormant status. What do we mean by dormant status as a consequence of non-compliance? The company may be listed as not in good standing, which may affect bank accounts, which also may affect it may affect bank accounts. The dormant status may also affect contracts that are entered into by the company. The contract may be declared null and void because the company is dormant. It is not in good standing. That is a consequence of non-compliance. That is a consequence of failing to file annual returns. Another consequence is striking off. The company may be struck off. Persistent failure can lead to the registrar of companies. The registrar of companies may possibly dissolve the company and seize its assets. It can lead to striking off of the company. The company may be dissolved because of failure to file annual return. Consequence number 5 is personal liability. Personal liability. What do we mean by personal liability? Personal liability. Directors can be held personally liable, and in extreme cases, they could be prosecuted. Understand? Yes, so these are consequences of non-compliance. And that effectively brings the lesson to an end. The topic is governance, standards and guidelines. Today we are studying GS007, filing annual returns. We've defined what an annual return is. We've said an annual return is not a tax return, but it is a statutory document that summarizes the legal structure of a company as at a specific date. It is just a document that confirms the company's registered office, the company's officers, the share capital, the shareholders, and the indebtedness of the company. In this lesson, we've studied the deadlines and timings of making annual returns, of filing annual returns. The first milestone is the return date, which is usually the anniversary of the company's incorporation. The second milestone is the filing window. The filing has to be done between the 20th day to the 42nd day of the return date. Then there is the AGM link. These returns could be made shortly after the AGM is conducted. Then in this lesson, again, candidates, we have outlined the compliance checklist. Before the filing is done, the company secretary has to verify that what is contained in the annual return is what appears in the company's records. Then there is certification. At least one director is required to sign the annual return. Number 3, in certain jurisdictions, the financial statements are required to be attached to these annual returns. Then number 4, the compliance checklist. The fourth one is payment. We've said that lodgement is only considered complete once the statutory filing fee is paid. And of course, lastly, we've discussed the consequences of non-compliance. Non-compliance can lead to automatic fines, dormant status, striking off, and also personal liability. That's the end of today's lesson. Thank you for attending the lesson. Make sure you go through the video again, take notes, then go to our revision partners. We have questions on this topic, governance standards and guidelines. Attempt the questions without looking at the answers that are provided at the back of the book. You understand? At the end of this topic, please get hold of our revision partners. We have analyzed Kasneb past paper questions, topically arranged for your ease of revision. Attempt questions on governance standards and guidelines before looking at the answers at the back of the book. Thank you for taking your time to study with us. In our next session, we are going to the next governance standard, number 008, common seal. Bye-bye.
Welcome to our second lesson on Microsoft Excel. My name is Nicholas Sikali. In our first lesson, we talked about definition of Excel. We explained, or you were taught, that Excel belongs to the spreadsheet industry, and you are also taken through the window of Excel, the parts of Microsoft Excel window. In this lesson, we are going to learn how to manage a workbook and a worksheet. Now, a workbook refers to a single open file in Microsoft Excel. That is a workbook, a single open file in Microsoft Excel. Like what is open here is book 1. So it means the entire file that is open before us is what we are referring to as a workbook. So this is book 1, though the name can be changed later as you are going to learn how to rename a workbook. Now, a worksheet refers to an interaction or an intersection between several rows and columns. So a worksheet refers to an intersection between several rows and columns. And you are seeing here, we have rows and we have columns. Columns are usually identified by alphabets. So we have column A, column B, column C, column D, all the way to, of course, the last column here, X, F, D. That is the last column. Rows are usually identified by numbers. You can see row 1, row 2, row 3, all the way to the last row, which is 1,048,576. So that one is the last row in Excel there. Currently, a workbook comes with one worksheet. So you can see sheet 1 here. A workbook comes with one worksheet. That's why we are seeing sheet 1. But a user can be able to add worksheets and can also be able to remove worksheets. Now, in previous versions of Excel, workbooks used to come with up to 3 worksheets. So we used to have up to 3 worksheets, but currently we only have 1 worksheet in a workbook. So when talking about the worksheet relationship, it's just like your normal book, one book, but if you open or if you flip through that book, it have different pages or different sheets of paper. So even in Excel, you can work or you can work with one workbook, but you can also be able to introduce different types of sheets, just like your book has different sheets or pages. Now, having known the difference between a workbook and a worksheet, let us start by learning how to save a workbook. How do you save a workbook? Now, to save a workbook, you click on File, then you select Save. Or you can also use Save As if you're saving for the subsequent time and you want to change the file name. So you click on File and you select Save. This will provide you an opportunity to save either in your recent places. You can save it in OneDrive. You can save it in this PC. You can add a place that you want to save your work. Or you can browse through the computer. Let us browse through the computer and see where we want to save our work. So we have browsed through and you can see this allocation here. Currently it means that you are saving this particular workbook in documents. Inside this PC, but in documents. You can be able to change the location that you want to save your work. It can be in desktop, downloads, documents, pictures, or wherever you want to save. Let's say we want to save our work in the desktop. So it changes immediately. It is inside this PC, but now it's from documents to desktop. Now you can save here, but remember it's usually very important that you create a folder under which you want to save your work. So folders are meant for you to save your files. So there are different folders that have already been created here, but I want to save my workbook in a new folder. So there's an option of create new folder, which I'll click on. Once you click on new folder, you will see a new folder here created for you. And you can easily change the name from new folder 3 to another folder name like introduction to MS Excel. So I can give that as my folder name. You can edit if you feel like you want to edit anything. Once you have introduction to MS Excel or whichever name you want to give it, you can double click to open that folder, or you can click on open here. So either way it works. Remember, we are now inside that folder. You can see the location has changed here. You are saving it on the desktop, but inside a folder known as introduction to MS Excel. This folder has just been created now. So you can also change the file name from book 1 to another file name, assuming that we want to give it a name, Excel practice. So you can give it Excel practice. And there we have. So we've changed the name from book 1 now to Excel practice. After that, you can just click on save and it will be saved. What you notice here is that the name has changed from Excel practice. Now it is written, the name has changed from book 1 and it's now Excel practice. So that's how to save a workbook. Then if you close it, assuming we close that workbook, even if you go to the desktop, you will be able to view that we have that folder that we just created, Introduction to Excel. This is our desktop, Introduction to MS Excel. If you open it, you will see that Excel file, which is a workbook that was changed from book 1 to Excel practice. So you can see Excel practice. If you click on it, it opens. the way ours has opened again. So that is how you save a workbook. Now, assuming that you want to change the name, then you'll be using Save As. That means that, remember, the current name is Excel Practice. If you want to change it, click on File. Now you can use Save As. If you use Save, it won't give you that opportunity to change the name or even change the location. But if you want to change the name and again change the location, now we'll be using Save As. So if you click on Save As, then you locate where we saved it. It gives you an opportunity again to be able to change the name. So this is Excel Practice. If you want to change, that can work. So we don't want to change, so I'll cancel and go back to our workbook, which is open. Now that is how to save a workbook. There is also creating worksheets. Remember, earlier on, I gave you a difference between a workbook and a worksheet. A worksheet simply refers to different or several pages that are created inside a workbook, and it consists of an intersection of rows and columns. So several intersection of rows and columns make a worksheet. This entire place where you are seeing intersection of rows and columns is a worksheet. Columns are headed by alphabets. Rows are headed by numbers. A single intersection between a row and a column is known as a cell. A single intersection between a row and a column is known as a cell. For example, this is cell A1, where my cursor is. This is cell A1. You can see it's written here, A1. If you move here, this becomes cell B1. If you click here, this one becomes cell C5. You can see C5 here. So it keeps telling you the cell that you are in, cell F3. So when reading a cell, Excel starts with the column heading, following it up with the row heading. So column F, row 3, or column D, row 2, or column S, row 5, or the last one here is column T, row 20, hence the name T20. So the first one is usually known as A1. If you select a group of cells together, that is a range. So a group of cells selected together is referred to as a range. A good example, if I click on cell B2, I hold down my mouse and drag down, that becomes that range from, this is range B2 all the way to B11. Though here, it only gives the name of the first cell, B2. But when writing it, it is B2 all the way to B11. Ranges are separated by full colons. So if you are writing it down in a formula, it will be from the first cell to the last cell. So this is B2, full colon, B11. B2, so maybe I can, that one is B2, then full column, it was up to, let's say, B11. So that's how you write ranges of cells. So B2 is here all the way to B11. B2, B11. Remember, you can even select this way. This one becomes B3 to G3. B3, G3, separated by a full column. What if you select like this? That one becomes A2 because it starts, B2 I mean, it starts from B2, the white one here, B2 to the last cell. So it will be B2 all the way to I14. B2 to I14. The ones that are white, B2 to I14. So that's how you identify cells and also how you identify ranges in a worksheet. So the key terms there, we have a workbook, we have a worksheet, we have a row, we have a column, and we have a range. Those are very, very important key terms that we'll be using in Excel. Now back to how you create a worksheet. Remember, I told you that a workbook comes with one created worksheet, but you can be able to create more. How do you create a new worksheet? It's a very, very simple simple task. At the end of sheet 1, you can see sheet 1 here at the bottom. There is a plus. The plus is known as new sheet. You can see new sheet. If you click on the plus, it gives you sheet 2 now. If you click on the plus again, it gives you sheet 3. Now from one sheet, now we have 3 sheets by creating them very fast. So if you are saying you have your data here, this is your financial accounting data in sheet 1. You can see in sheet 2 there is no financial accounting. You can write maybe cost accounting data. Then in sheet 3 you can be able to write maybe taxation data. Now those are different worksheets that carry different things. Just like in your book, you can write something in page 1, in page 2, and in page 3, but in one book. So that is what worksheets do in Excel. Now that's how you create a worksheet. Or apart from just clicking on the plus, there is also another way of creating a worksheet by clicking on insert here. So there is, under the home menu, there is cells. Under cells, there is insert. Then you can see insert sheet. You just click on insert sheet, you'll see sheet 4 here. Again, you can be able to just click on insert, then insert sheet. So that's another way of inserting. They keep being created that way. So that's how you create worksheets in Microsoft Excel. You can create as many worksheets as you want. A good application of where the worksheets could be used, is where you are a payroll a personnel or a human resource personnel, and you are trying to come up with a payroll for the year 2022. So this one could be a payroll for January, for February, for March, April, May, all the way to December. So it means you'll be having 12 worksheets containing payrolls for the 12 months of that particular year. So the workbook name will be payroll 2022. So workbook payroll 2022. Then the worksheets will be having the different months that are there in a year. So that is creation of a worksheet. How then do we rename a worksheet? Let's say we are renaming a worksheet. And assuming that this one is January. So to rename a worksheet, you can double click on it. With your mouse, you can double click on it. Of course, if you double click, it will be active and you give it a name. Or you can right click and rename. You can right click on the worksheet and rename. So you just right click here on the worksheet. Remember, don't right click inside a cell like this. It won't give you that option. You right click on the sheet that you want to change and select rename. This one will be February. You can keep changing the names. This one can be March. You can right click and give this a name April. You can right click and give the last one a name May. Now when giving these names, you can see January, February, March, April, and May. Avoid, there are some characters that are not used. For instance, if I create a new worksheet here and I'm renaming this to June, let's say June, and maybe I put some funny character like a comma or something like that, there are those specific characters that are not accepted when renaming worksheets. Something like, let's say, June, can say June, something like a question mark. Let's say you want a question mark, or you want those things are not allowed when renaming worksheets. So we can give it June the normal way, like that. So there is January, February, March, April, May, and June. So that's how you create and that's how you rename these worksheets. Now, having renamed the worksheets, let us also learn how to delete a worksheet. What if you want to delete a worksheet? Now, deleting a worksheet, again, you will right click on the worksheet and just select delete. Remember, the process of deleting a worksheet is irreversible. You cannot undo. So always confirm if indeed you want to delete that worksheet before deleting it. So I will delete it. It's gone. Or you can just go to under cells here, then select delete, then delete sheet. It also helps you in deleting that worksheet. You can see, we'll permanently delete this. Do you want to continue? Say yes. So May is also gone. So we remain with January, February, March, and April as our worksheets. Having created that, we also want to learn how to change the worksheet tab colors. You can also be able to change the worksheet tab colors. The same thing, you can right click, then you select tab color, then you can give it any color. So we've given a color for January. You won't be able to see it unless you click on the next worksheet. For instance, you can see now the green. You can even change to another color if you want. March can be given another color. So this one requires people who have a good taste in selecting different colors. You can see. Then there's the last color here, which can be yellow. So all those worksheets now have colors from January, February, March to the last one. So this can go on and on and on as you create worksheets, as you delete them, as you rename them, as you change the color. Now one can also hide a worksheet. If you want to hide a worksheet, for instance, you don't want February to appear, you can right click and hide a worksheet. But if you want to unhide, of course, you can unhide a worksheet. It comes back. You can see February was hidden, it now comes back. So you can also be able to unhide all these options. You can see insert, delete, rename, there is hide and all that. Tab color and that. So this is January all the way to April. Now there's also another very important thing. One can be able to copy or move a worksheet. You can copy or move a worksheet. So assuming I want to copy this worksheet, remember it can be copied and moved either to the same workbook or in different workbooks. Assuming I want to copy January and replicate it, remember January is written financial accounting, I can right click, I'll select move or copy. Under move or copy, they are asking you, you are moving it to which book? Is it the same book? Our book is known as Excel Practice. Or you want a new book. If you want a new book, you can also be able to create a new book. So I want to move it to the same workbook given this name. So I'm not changing. It is the same workbook. Excel Practice, which is the same here, Excel Practice. So it's Excel Practice. Then you are moving it where? Before which sheet? Before January, before February, before March, or before April. Or you can move it to end. So I want to move it to end. So you click on move to end. Then you create copy. So for you to be copying, then it will force you to create copy. Otherwise you will be moving. So if you don't create copy here, you will be moving it. Okay? Then you can see this January, and there's also January in bracket 2 to the end. So there's January in bracket 2 to the end. It means you've copied this worksheet and taken it to the end. Remember we said move to end. So there's another January. If you click on the first January, you can see financial accounting. If you click on the last January, you can also see financial accounting. So that's how you copy a worksheet. A user can also move a worksheet. Now copying means that you leave the original in the place that you found it. Moving means that you take entirely a worksheet from one place and take it or transfer it to a new area without leaving a copy to the from the initial destination. So I want us to move January in bracket 2. We are moving this. So you right click in it, or you right click on January. Then select move or copy, move or copy. Then you say to book. So we are moving it to a new book, not Excel Practice. We are moving it to a new book. So you click on new book. Don't create copy. If you don't create copy, it means you are moving. If you create copy, it means you are copying it, and the original will be placed there, will remain at the place that you found it. So we are not creating copy. You just click on OK, and it has moved. Now this is a different workbook, and you can see January 2, it has been transferred here. Our financial accounting remains here. Now it's a new book, because you can see it's written book 1. Our book, you can see it at the background there, it's written Excel practice. But this one is known as book 1. So this one is a totally new workbook. So that is moving a workbook from one workbook, moving a worksheet from one workbook to another worksheet. Moving a worksheet from one workbook to another workbook. So I want to close book 1. I don't need it. And I'll not save it. Don't save. So there is no January 2, because we moved it entirely from this workbook of Excel practice to a new workbook which was created and named book 1. So there is January, February, March, and April. So those are very, very important tasks that you can be able to perform in workbook and worksheet management. Finally, the last thing that we will be looking at is how to protect your worksheets. Remember, data that has been created here can be protected. You protect it from unauthorized editing. You also protect it from maybe somebody who wants to make changes which you have not approved. So assuming that we have financial accounting, then we have student, then we have semester 1, we have semester 2, and we have semester 3. You can have Julie, you can have Patrick or Patty, Patrick. You can also have Carlos, like that. And they have scored 50. This one has scored 60, 76. Then this one has scored here 65, 54, 69, 80, 50, and 44. Remember, the worksheet January is editable. One can be able to easily edit and do anything that they want. If you want to get the totals, the totals can also be able to be obtained, of course. But what we want to do is to protect so that nobody can add something else. So for you to protect editing of these worksheets, right-click on January. Right-click on that worksheet that you want to protect. Or you can go to, there was also another area of protecting worksheet under the cells here. You can see under cells, this format from which you can be able to protect sheet. So I want us to protect this worksheet using the simplest way. You right-click on January and select Protect Sheet. Then what are you protecting it from? You can be able to select all these things so that nobody can be able to do anything. So there is allow all users of this window too. You can see, do you want to allow anything? We don't want to allow anything. You can protect worksheet and contents of the locked cells. So you just insert a password. Any password, like ours here is 1, 2, 3, 4. And let's say, okay, you again, 1, 2, 3, 4. Confirm the password and you click on OK. So it means the data here cannot be edited. A user cannot, or somebody who is not authorized to edit cannot. You can't type anything. If you try typing anything, they are saying that the cell or chart you are trying to change is on protected sheet. To make a change and protect the sheet, of course, you might be requested to enter a password. So you can't do anything. You look at the home menu, all these things are inactive. Insert menu, inactive. Page layout, few of them are inactive. And the formulas, and you cannot be able to do anything. The data, most of the items, especially in the home menu, are inactive. So you cannot add anything to this particular worksheet unless you have the password. So that is how you protect worksheet. If you want to unprotect that particular worksheet, again, you right click on it and select unprotect. But before we unprotect, what about these other worksheets like February? Remember, it's January that is protected. Looking at February, it's very active. You can be able to continue typing whatever you want. March is not protected, so you can type whatever you want. April is not protected, you can type whatever you want. Coming back to January, it is protected, and trying to write anything is disallowed. So that's how you protect a worksheet in Microsoft Excel. To unprotect it, you right click on it and select unprotect sheet. So unprotect sheet, you provide the password 1234 and you click on OK. It means it's now unprotected. And again, if you want to add done, you can be able to add done and insert the marks that done got in that order. So that's how you protect worksheets and unprotect worksheet. That marks the end of that particular lesson. But before I sign out, you have some tasks to do. In this lesson, we learned how to save a workbook. We learned how to create worksheets. We learned how to rename them, how to delete them, how to change the worksheets tab color, how to copy and move them, and how to protect worksheets. Your task to do is to create a workbook, give it a name of your choice. So tasks to do: create a worksheet, create a worksheet, not a worksheet but a workbook, and name it, let's say payroll. Name it payroll 2022. Save it in a folder named ABC Limited, created on the desktop. Then create 12 worksheets. Create 12 worksheets inside your workbook. Giving them not giving them but naming them from January to December. Give your worksheets different tab colors. So we'll be editing. So give your worksheets different tab colors. And finally, try and type in some data. In worksheet named May and protect it with a password. So that is your task to do. Maybe the last task is that try and copy or move worksheets. Move one worksheet from your current workbook to a new workbook. So once you worked with these tasks that I've typed here, then it means that your understanding of this particular lesson would have been enhanced. Thank you, and see you in our next lesson.
Hi candidates, welcome to another session of Manifested Online Classes. We are still continuing with the topic of group account, and in this session I want us to look on another concept of group accounts, and the concept is changes in group structure or disposal of interest. So when talk about the disposal of interest, or basically changes in group structure, this whereby the parent company will sell all the shares held in a subsidiary, or basically sell part of the shares and retain some of the shares held in such what? A subsidiary. So therefore, what we're going to do here is we're going to look on how to prepare the group account whenever there is changes in the group structure, or basically we have now the disposal of what? Of interest. But before we even do that, we can have an introduction to this, and we say that changes in group structure occurs when the parent company sells the whole or part of shares, whole or part of shareholding in the subsidiary company, subsidiary company. So basically that's what we refer as the disposal of interest. So the parent company here will sell some of the shares, or basically all the shares which are held in what? Which are held in a subsidiary company. Now generally the disposal of interest can be broadly classified into two main categories. First of all, we have what we refer as a full disposal. A full disposal is whereby the parent company sells all the shares which are held in a subsidiary. That is a full disposal. But on the other hand, we have a partial disposal whereby the parent company sells some of the shares held in a subsidiary and retain some of the shares. So therefore here we can talk of types of disposal of interest, So when we say there are two types of this, we say disposal of interest can either be, number one, we have the full disposal, and then we have the partial disposal. Disposal. But in accordance with the International Financial Reporting Standard number 3, a disposal of interest basically occurs when the parent company loses control. So mean that once the parent company sells some of the shares which are held in a subsidiary company, and the parent company now loses control. So mean that the shares which will be held by the parent company in the subsidiary falls below 51%. So actually from 50% to 0. That is the time the disposal is deemed to have occurred in accordance with IFRS 3, in which case then the parent company is required to determine something called the gain or loss on disposal. So therefore the gain or loss on disposal basically is determined when the parent company loses control. So therefore you can say according to IFRS 3, International Financial Reporting Standard number 3, disposal of interest
of interest occurs when the parent company loses control. When the parent company loses control. The parent company loses what? Loses control. So basically what that means is that the shares now which are retained by the parent company, the subsidiary, or basically the parent company will sell some of the shares and retain shares which are less than 51%. Less than 51%. So that is the time the disposal take place. And in such a case, then we are saying the parent company should proceed and determine the gain or the loss on disposal. What is important, therefore, to note as far as that point is concerned is that if the parent company has retained a control, when talk about retaining a control, this whereby we can be told A Limited, which held 80% of the ordinary shares issued by B, the parent company we can be told like sold like 20% of the shares. 20% of the shares. What does that mean? It means that the parent company has retained 60% of the shares in what? In B. In such a case, you can see the parent company still having a control, because we said a company or an investor company will have a control of the investee, whereby the shares held by the investor company, the investee company, lies between 51% to 100%. So, but you're saying disposal in accordance with IFRS 3 occurs anytime the parent company loses control. It sells some of the shares here and retain shares which are now less than 51%, from 50% to 0. In which case we are saying a gain or a loss on disposal should be what? Should be determined. And therefore you can say when disposal of interest occurs, that is when the parent company loses control, control, a gain or loss on disposal should be computed or should be determined, we can say should be determined as follows. So how do we compute that particular gain or loss on disposal of interest? So gain or loss on disposal of interest. So to determine this gain or loss on disposal of interest, number one, we take the fair value of purchase consideration received. So when the parent company sold some of the shares, or basically all the shares in a subsidiary, how much amount was received by the parent company? So that is now what referred as the fair value of purchase consideration received. To this we add the fair value of investment which has been retained. When talk about the fair value of the investment which has been retained, so this basically applies in case of a partial disposal, whereby the parent company has not sold all the shares in a subsidiary. If, for example, the A Limited, which is the parent, which initially had acquired 80% shareholding in B, which is the subsidiary, if, for example, the parent company sells like half of these shares, sells 40% of the shares held here, it means that the parent company has retained a shareholding which is equal to 40%. So at the date the disposal took place, the remaining investment will have to be revalued at its fair value, and always that figure will be provided to you. That's what we refer to as the fair value of the investment retained. So after adding those two figures, we come here and we less, number one, the fair value of net assets, held at date of disposal, So So the fair value of the net asset held at the date of disposal. And then to this, we also add the parent company and impaired goodwill. The parent company and impaired goodwill. And after deducting those two figures, we can get a positive figure here. If a positive figure, that is a gain. But if a negative figure, this is a loss on disposal. A loss on disposal. Yes. So this is basically how the gain or loss on disposal is determined anytime the parent company has lost the control. The parent company sells some of the shares held in a subsidiary, and therefore it retains shares which are less than 51%, from 50% to 0. Always in such a case, we compute the gain or loss on what? The gain or loss on disposal. So then next, we can proceed and look on how we prepare the consolidated financial statement anytime we have changes in the group structure. So let's look on the preparation of group accounts. So in this case, we're going to look on how we prepare the group accounts at different types of disposal. So remember, you have said that disposal of interest can be broadly classified into two: partial disposal and the full what? Disposal. Let's start with the full disposal. The full disposal. A full disposal generally is whereby the parent company sells all the shares held in a subsidiary. Maybe first of all, you can say that this is a whole what? Disposal, or basically a whole sale of shares in a subsidiary. So a wholesale of shares in a subsidiary company. And this one is basically governed by IFRS 5. So basically, in terms of how the parent company should treat that particular subsidiary which has been free disposed, that should be accounted for in accordance with IFRS 5, meaning that that subsidiary now will be termed, or basically will be referred to as a discontinued operation. Assuming we are told A Limited had acquired 80% shareholding in B Limited, and the parent company sells all these shares. So if that is the case, then this particular subsidiary is a discontinued operation, and should be accounted for in accordance with what? In accordance with IFRS 5. So what IFRS 5 requires is that the parent company should, number one, determine the gain or loss on disposal, and number two, the parent company should determine the gain or loss reported by that discontinued operation, and that one should be recognized, or those two items, the gain or loss on disposal of interest, the profit or loss from the discontinued operation, they should be recognized as separate items in the consolidated income statement. So therefore, we can say in this case, the parent entity or basically company should determine, or in other terms, determine, number one, the gain or loss on disposal, of interest, and number two, the profit or loss from discontinued operation. from, we can abbreviate this as DO, from discontinued operation. Discontinued operation. And you are saying that these two items, that is the gain or loss on disposal and the profit or loss from discontinued operation, this should be recognized. This should be recognized as a separate line items in consolidated statement of profit or loss. Should be recognized as separate line items in the consolidated statement of profit or loss. Let's maybe from our group structure here, we introduce another company here, that is C Limited. We also assume that the parent company had a shareholding of 75%. So, and also we are told that the parent company, that is A, had 80% shareholding in B Limited, but we are told during the current financial year, the parent company sold all the shares held in B. So we have said B is a discontinued operation. So therefore, when A Limited is preparing the consolidated income statement, the consolidated income statement or the consolidated statement of profit or loss. So the parent company should first of all determine the profit or loss from the continuing operations. So the continuing operations will be the parent company and the NC, because you have said this one is a discontinued operation. So therefore, the parent company should determine what? The profit or the loss from continuing operations. Continuing operations include A and C. And for the parent company to do that, basically, in this case, we take the revenue of this, that is A, plus the revenue of C. And then we also take the expenses, including the cost of sales of A plus that of C, We less that now from the revenue. We get, whatever you get here will be the profit or loss from continuing operations. Continuing operations. And then we are saying that these two items here should be added to the profit or loss from the continuing operations. So then we have the discontinued operations. Discontinued operation, basically, you have said, is this subsidiary which has been disposed. So two items will be included here: the gain or loss on disposal of interest. And you have to recall that this one is computed using that particular approach there, or that particular format there. And then we also have the profit or loss from discontinued operation. So how do we determine this profit or loss from discontinued operation? So we take the revenue of this company. For example, the parent company sold the shares held in B Limited, for example, 6 months from the start of the current financial year. So in that case, you take the revenue of B for the first 6 months and also its expenses for the first 6 months, and then determine the profit or even the loss which was reported by that subsidiary B, which was fully disposed. You'll get the profit or loss from the discontinued operation. So if it's a profit, you add. If it's a loss, we do what? We less here. We less. And then we add that now to the profit or loss from the continuing operations, and then we get the profit for the year. The profit for the year. So that's basically how we deal with what refers as a full disposal. And basically, remember, these are priced in preparation of a consolidated statement of profit or loss. Consolidated statement of profit or loss. So basically, when now preparing the consolidated statement of financial position, at the end of the year, the parent company will have fully disposed its shares in this subsidiary. So the parent company will not be having any control. Equally, there will be no NCI. So therefore, we can say that when preparing this consolidated statement of financial position, we can say there will be no NCI, or basically we can say assets and liabilities of subsidiary fully disposed are not included in consolidated statement of financial position. So the assets and liabilities of that subsidiary will not be included in the consolidated statement of financial position. And equally, as far as that subsidiary is concerned, there will be no NCI. The minority shareholders will not be entitled to share the net asset of that subsidiary as at the end of what? Of the year. That's basically how we deal with the what we refer as a full disposal. Then from there we have the other type of disposal. Recall in our case here we have said that we have two types of disposal: the full disposal and the partial disposal. Partial disposal. Now here we have different types of partial disposal. Actually, we can say we have different scenarios of partial disposal. Number one, or number A, we have what we refer as a disposal of a company which was initially a subsidiary and which still remains a subsidiary. A subsidiary company to a subsidiary. So when talk about a subsidiary to a subsidiary, this whereby we can be told the parent company had like 80% shareholding in B Limited, and the parent company, for example, sold 20% of the shares. So if it sold 20% of the shares, then it means that the parent company here retained 60%. So therefore, you can see B Limited still remain a subsidiary. So when it comes to preparing a consolidated income statement, what you do, you take the revenue and expenses of that subsidiary, you add to that of the parent. Actually, that disposal do not have any effect as far as the preparation of the consolidated statement of profit or loss is concerned. On the other hand, when preparing the consolidated statement of financial position, because this company is still a subsidiary at the end of the year, you take its assets and liabilities, you add to those of the parent. Actually, this particular type of partial disposal do not have any effect as far as the preparation of the group account is concerned. It's also important to note that here, because the parent company is not losing control, no gain or loss on disposal of interest is computed. This one is not computed because you have said we only compute that one anytime the parent company loses what? Control. So we can say no gain or loss on disposal of interest. On disposal of interest. So that is it about that scenario of partial disposal. So the other type of partial disposal, part B, is a disposal which makes a company which was initially a subsidiary to be an associate or a joint arrangement. So first of all, you have to recall from what you have discussed in our previous sessions that investment in associate, investment in joint arrangement should be accounted for in the same way using the equity method. That is something, first of all, you have to recall, and that's why you can see here we are talking of associate or the joint arrangement at one point. So this whereby we assume that the current financial year was ending on 31st of December 2023. That is the date of consolidation when the group accounts are supposed to be prepared, meaning that the year started on 1st of January 2023. We may be told that the parent company initially had acquired like 80% of the shares, 80% of the shares, like maybe A Limited had initially acquired 80% shareholding in B Limited some time back, but during the current financial year, maybe on 1st of July 2023, the parent company sold or disposed 40% or half of these shares. So mean that the parent company sold 40, and that means that the parent company then retained 40%. Retained 40%. So if it retained 40%, then it means that this company, which was initially a subsidiary, then becomes what? An associate. Becomes an associate. And therefore, in the first 6 months, the parent company, you can see, had 80% shareholding, meaning that this company was therefore a subsidiary. And then after selling half, the parent company retained 40%, meaning that in the last 6 months, that company was what? Was an associate. Was an associate. So how do we go about in this case, or how do we prepare the group account in such type of a partial disposal? Number one, when preparing the consolidated statement of a profit or loss, in preparing the consolidated statement of profit or loss, number one, we have to compute the gain or loss on disposal. We have to compute the gain or loss on disposal of interest, of which this particular gain, if it's a gain, it is recognized as an in the income statement as an income. If it is a loss, it is recognized as an expense. Number two, we then consolidate the results. The results of the subsidiary company up to date of disposal. Up to date of disposal. Up to date of disposal. Like in this case, in preparing the consolidated income statement, we're going to take into account the revenue and expenses of B for the first 6 months when it was a subsidiary. And then in the last 6 months, because it was an associate, you have to recall that we don't include the revenue and expenses of associate in the consolidated income statement. So that's why we are saying consolidate it results up to the date of disposal, and thereafter include group share of its profit after tax, and that is in accordance with equity method. That is in accordance with IS 28, because as far as the associate is concerned, we include, or what we include in the consolidated income statement is the group share or the parent company share of its profit after tax. So mean that you'll take the profit after tax of this company here, which is always given in its income statement, multiply that with 6 all over 12, so that you get now the profit after tax for the last 6 months when it was an associate, and then multiply that with the parent company shareholding in B, which is 40%. So that's basically how we prepare that. And then how do we prepare the consolidated statement of financial position? Consolidated statement of financial position. So in preparing the consolidated statement of financial position, our interest is basically the status of this company at the end of the year. So what will be the status of the investee company at the end of the year? At the end of the year, the investee company, that is B, will be an associate. And therefore, in accordance with the equity method, what we include in the consolidated statement of financial position as far as the associate is concerned is something called the investment in associate. We don't include, or we don't combine the asset and liabilities of the parent, those of the associate, in preparing the consolidated statement of financial position. So therefore, in preparing this, we say compute the investment in associate or joint arrangement and included in consolidated statement of financial position as a non-current asset. So in that case, we compute something called the investment in associate or investment in joint arrangement, and we include that in the consolidated statement of a financial position as a non-current asset. So how do we compute this particular investment in associate or joint arrangement? So investment in associate or joint arrangement. So this one is computed using this approach here, or this format. So number one, we take the fair value of investment which has been retained. Fair value of investment retained. So the investment which has been retained here is 40%. And basically we have said that in case of a partial disposal, the investment which has been retained always will have to be revalued to its fair value on the date of disposal. That figure will always be provided to you. So you'll be told that the investment which has been retained on the date of disposal had this fair value. That's what you use here. And then to this we add the group share of post-acquisition net assets. Post-acquisition net assets. And whatever you get here is now what you refer to as the investment in associate, investment in joint arrangement, and you're saying that that should be taken to the consolidated statement of financial position as one of the item of the non-current asset. Yes. So basically those are different scenarios of partial disposal, and basically how we deal with them specifically in preparing the consolidated financial statement. So basically that's what you need to know. I want us to stop at that particular point. Once we come back in our next session, I want us to look on an illustration question regarding how to prepare the group accounts and also how to compute the gain or loss on disposal in case of disposal of interest. So see you in the next session.
Hello learners, welcome today to session 3 or lesson 3 where we want to look at long run analysis of costs. Long run analysis of costs. Long run analysis of costs. So in the short run, we said that this is normally a period where at least one factor must be fixed and the other should be variable. In the long run is where all factors can be varied, and therefore we do not have any like law of diminishing returns to variable factor, because we are assuming that all factors can be varied. Varied meaning we can interchangeably vary the proportions of different factors. Why? Because they will not remain constant, as in the case of short run analysis. So what operates in the long run is the economies or these economies of scale. So when the firm factors can be varied, the firm can either experience economies of scale or diseconomies of scale. So in this lesson, we want to look at economies of scale in relation to internal economies of scale. So what are economies of scale? Economies of scale are simply those advantages that a firm enjoys after it has expanded. We normally have what we refer to as an optimal size of a firm. And an optimal size of a firm is simply that efficient size that a firm can have so that it's able to produce at the minimum or the lowest production cost per unit, so that it has no option of either increasing or decreasing its level of output. So in that case, we say that the farm is operating at its optimal size. And that's when economies of scale will come in. So in economies of scale, we want to begin with internal economies of scale. So what are internal economies of scale? These are those benefits, or I refer to them as advantages, that a farm can experience that are coming from within. They have nothing to do with the outside. What are the happenings that are happening in the organization, like when the farm has expanded, that can be a benefit to the farm? That's what we refer to as internal economies of scale. So they are as follows. We have what we refer to as technical economies of scale. So technical economies of scale, like when a farm increases in its size, it is normally able to use sophisticated or modern technology. And when it is using modern technology, it will be able to increase its level of output than that farm that has not expanded. And under technical economies of scale, we have such benefits like what we refer to as indivisibilities. So what are indivisibilities? Indivisibility is simply where a farm is able to take advantage of a process that cannot be reproduced on small scale. So one of the technical economies that a farm will enjoy is what we refer to as indivisibilities. And indivisibility is simply where a farm is able to take advantage of a particular process that cannot be reproduced on small scale. So that simply means this farm will have a process or a particular process which a small farm cannot have. Like, for example, when a farm has a particular machine that can enable it to produce, and when it is producing to in large scale or in large quantities, which a small farm cannot be able to produce. Why? Because a small farm produces on small scale. We say it is enjoying a benefit of indivisibility. We have another one which we refer to as increased dimension. Increased dimension is where a farm can increase its equipment, can increase the capacity of its equipment so that it is able to produce a larger output without increasing costs. That is increasing without increasing production costs. So increased dimension is where when a farm has a particular equipment, it can decide to enlarge or to increase the capacity of that equipment so that it's able to produce a larger output than what it has been producing before without necessarily increasing the production cost. I can give an example, like for these commercial services, you've been having or owning a matatu. A matatu has one driver. And then because your business has enlarged, you now decide to bring in a bus. So a bus still will need one driver, but the capacity is more large than that of a matatu. So in that case, that benefit is called increased what? Dimension. You are producing more, but you are not necessarily increasing the production cost. And if it is there, then it is very minimal. And then number 3, Roman 3, still part of technical economies of scale, we have another benefit of linked processes. So linked processes is simply where a firm can link up its processes that can enable it minimize its costs. So linked processes is where, like, we have firms that buy raw materials, and once they buy those raw materials, they use the raw materials in the production of goods and services. And then once they have produced goods and services, they again market for those goods and services before they are sold. So linked processes is simply where a firm can decide to supply for itself raw materials as well as produce the goods. It can even go up and do the marketing by itself, so that it is reducing costs such as fuel cost. You don't need to get raw materials from another supplier, bring them before you produce. You simply have a portion where you are supplying raw materials. So instead of buying them from outside, you simply use what you already have, and then you will be able to do what? To produce using minimal costs. Why minimal costs? Because we will cut costs to do with transportation, etc. Those are called linked processes. And then we also have another one still on technical economies called specialization. So specialization can be where a firm can specialize, like in terms of machinery and labor, so that it produces what's quality, so that it produces what is quality. So specialization is where a firm can simply decide to specialize on a particular machine. So it buys a special machine that will enable you to produce what is quality, or have a specific class of workers who are able to help in production of that which is quality. So when we talk of competition, what happens? Because they will be producing what is quality, their products will be more competitive than of those other firms. And then we can also talk about research, still under technical economies. Research is like when a firm has grown, it has an ability of conducting a market research. Like whenever it wants to introduce a new good or a new product, it can be able to know what are the needs, what are the tastes and preferences of the people before it can design and produce what is to satisfy the need of its customers, which may not be so with small firms. So research is where a firm will be in position to conduct a market research, which can enable it to produce that which satisfies its customers. And when that happens, that means profitability of the farm will increase. When customers are satisfied with what you produce, they will buy more, and when the more they buy, the more you'll do what? The more you will make profit. That was number one. Then number two, we have what we refer to as financial economies. So financial economies is where when the farm grows or enlarges, it normally has more in terms of assets. And for example, whenever it wants to raise like a loan or funds from a financial institution, it is in proper position to provide security or what we refer to as collateral. And because of that, they will always raise funds at a lower rate, like in terms of interest, than those that are small farms. So financial economies is where a farm is able to raise funds from financial institutions at a lower cost. Why? Because at a lower cost because it is in position to raise assets that can be used as collateral. That can be used as collateral. Then number three, we have marketing economies. Marketing economies. So marketing economies is where when a farm expands, it will be able to like take advantage in buying in bulk. When a farm buys in bulk, it will enjoy quantity discounts. And when it enjoys quantity discounts, it means that it will be buying at a lower cost than what others will be buying at. And therefore, it will be always saving in terms of purchase. And then it can also enjoy economies to do with packaging. When it is packaging in large quantities, it is more cheaper than when packaging in small quantities. And then when it comes to selling and even distribution, it will have that advantage. So marketing economies, these are normally in the form of like buying in bulk. This enables the farm to take advantage of quantity discounts. Hence buying at a lower price, which makes them to save in terms of the purchase price. We also have packaging. Packaging is where I can just say packaging in large quantities. Packaging in large quantities enables a farm to save rather than packing in small. Why? Because when we pack in large quantities, the cost is normally spread on those units that are packaged in that one package. But when you are packaging in small quantities, then that simply means that you will incur a higher cost than a farm that is packaging in large quantities. And then number 4, we have diversification. Diversification is where when a farm enlarges, it has an ability of even producing more products. Like it can introduce new products. Why? Because it has an ability to do that. So like, for example, where there is competition, or when it is facing competition with other farms, it can decide to introduce new new products which can enable it to fight that competition, and that enables it to continue remaining on the market. So diversification is simply where a farm is in position to introduce new products. A farm is in position to introduce new products that can lead to increased profits, as well as acting as a risk management strategy. And then number 5, we have risk-bearing economies. So what are risk-bearing economies? Like when a farm expands, it can be able to predict risks better than small farms. Why? Because like when it is conducting a market research, it will be able to know what are the advantages, what are the disadvantages of its product, who are the competitors, and because of that, it can simply be able to use SWOT analysis so that it is able to do what? To minimize its risks than a small farm. So risk-bearing economies, we say that a large farm is able to predict risks than a small farm. Why? It has an ability to conduct a market research. It can conduct a SWOT analysis than a small farm. So those are the internal economies of scale. Then we have disadvantages, or these internal diseconomies. Can look at that shortly. Internal diseconomies of scale. So in our next lesson, we'll be looking at internal diseconomies of scale. So learners, have a good day. This ends or marks the end of our session.
To pick the highest value range. So 17,000 was the most expensive thing. It was a Land Cruiser, Toyota Land Cruiser. Then in the lowest cost, we will use mean function, open a bracket, highlight this, then it gives you the lowest out of those figures. So the lowest was 3,875. Again, you can format this as, because this is currency. Generally with currency, we tend to put two decimal places. So if you look at it, this one has no decimal places, so I can quickly format all of them, select the whole range, then add some decimal places. Okay, so that makes it two decimal places. This one, I can make this two decimal places as well, and format it to have a comma, so I can see clearly where the thousands are, or in some cases, where the millions are. So let me put a comma there as well. It kind of makes it easy to read. Okay. So a number of functions we have reviewed there. Just a quick run through of what we have done so far. If you recall, the duty, we started with the duty. We used the if function. The if function in this case had three parameters, three things inside the function.
Greetings, candidates, and welcome to the Business Data Analytics lesson. Today we are beginning the third chapter, which is core application of data analytics. At the beginning, we introduced the topic Introduction to Excel, where we went through the shortcuts in Excel. We studied or demonstrated on Excel how to use the data tables, the pivot tables, and other common functions. We also studied the advanced formulas and functions to enhance functionality of financial models. That's topic or chapter number 1. In chapter 2, we went through the introduction to data analytics, where we covered the CRISP DM, that is the cross-industry standard process for data mining framework. We studied the data concepts, that is the conceptual, the logical, and the physical models. We also went through the stages in the data cycle, identifying data sources, modeling data requirements, obtaining data, recording data, using data to make decisions, and removing data. We describe the whole process in the data life cycle. That is the second topic or subtopic. Then on the second subtopic, we went through the big data and analytics subtopic. We defined big data, we described the 5 V's of big data, and also the types of data analytics. That is the descriptive analytics, prescriptive analytics, and predictive analytics. We went further to describe the tools for data analytics, and we categorized the tools into 3. 1, the data cleaning tools, where we mentioned the Alteryx, the SSIS, the data stage. Then we described the data management tools, that is the SQL, the Oracle, the Microsoft Azure, and also the Amazon Web Services. Then the third aspect of tools for data analytics is the visualization tools, that is the Excel, the Power BI, Tableau, MicroStrategy, and others. Then, candidates, you will recall, having gone through the tools for data analytics, we covered the data visualization in Excel. We defined data visualization. We explained the benefits of data visualization. We also studied the types of visualization, that is comparison, composition, and relationships. Then lastly, we explained again the qualities of good data visualization. That is topic or chapter 1, 2, and 3. That is topic 1 and 2. Today we are moving on to topic 3, which is core application of data analytics. Now in topic 3, core application of data analytics, we are going to cover two core areas. That is the financial accounting and reporting, and also financial management. Those are the core areas or the core application of data analytics in the business data analytics paper. Now, under financial accounting and reporting, the first subtopic is preparation of financial statements. That is the statement of profit or loss, statement of financial position, statement of cash flows for companies and also groups. Co-application. Then under financial accounting and reporting, we'll analyze financial statements using ratios, common size statements, trend and cross-sectional analysis, graphs and charts. That is the second subtopic. The third subtopic is preparation of financial statement of preparation of forecast financial statements under specified assumptions. There is also the carrying out of sensitivity analysis and scenario analysis on the forecast financial statements. Then lastly, we will study the data visualization and dashboards for reporting. That is financial accounting and financial reporting. Under the core function financial management, we will look at the time value of money analysis for different types of cash flows, number 1. Number 2, loan amortization schedules. Number 3, project evaluation techniques using the NPV, the IRR. Then number 4, we will carry out sensitivity analysis and scenario analysis in project evaluation. Then lastly, we have the data visualization and dashboards. And candidates, these are core application areas. Core application areas. For those of you who are appearing in the business data analytics paper, that is the practical paper, these are the areas that you are expected to answer questions from. Just taking a sample of the December 2022 paper. This paper is presented in 2 sections. In fact, the instructions reads, answer all questions in section 1 and 3 questions in section 2. Section 1 has 20 multiple choice questions, each carrying 2 marks. Section 2 has 5 practical questions, each carrying 20 marks. Under section 2, you are required to create Microsoft Excel worksheets with the name of the entity in each question and input your workings and solutions. You may use the template within the question. So this is an application paper. That's why when we move on to the section 2, the practical part of this paper, that is a practical part of this paper. You can see in December 2022, the first question, that is question number 1, the question on Sepetuka Limited. Candidates were provided with a statement of profit or loss for 4 years, 2019 to 2022. Then candidates were required to calculate and interpret ratios. Calculate and interpret ratios using Microsoft Excel. These paper candidates were expected to answer the questions using Microsoft Excel. So the first question is on the financial accounting and reporting. Do you understand? Part B of the question, candidates were given information, then they are required to prepare 5-year forecast statements of profit or loss for Sepetuka. That's question number 1. Question number 2, candidates were given information, then they were required to A, compute the weighted average cost of capital to be used to evaluate projects. That is core application in financial management. That is question number 2. Question 3 again is on calculation of NPV and ex-NPV. So these are core application areas. Even question number 3, number 4, candidates were to prepare statement of cash flows for Bermuda Limited. Then in question number 5, the last question, candidates were to prepare variable costs per unit. This is managerial accounting. So candidates, we've begun the core application of data analytics, and I've said the first area for us to cover is the core application of data analytics in financial accounting and reporting. Core application. Core application of data analytics in financial accounting and reporting. Now, in these sessions, I'll be taking you through the theory part. After we've gone through the theory part, like understanding the concepts, then we'll move on to Excel, where we will answer questions in related areas like preparation of cash flows using Excel, calculation of the NPVs, the IRR using Excel, and the other areas under financial accounting and reporting. We also have a chance to answer these past paper questions that were done previously. If you go to the website, down there we have questions that have been answered in the past. You see how the practical paper was required to be done. But in these sessions, I repeat, we'll go through the concepts, the theories, and the procedures, and how data, we learn how data analytics is applied in financial accounting and reporting and other core areas like financial management. All right. Now, candidates, financial statements, by now we all know, are important documents that summarize the financial performance. They summarize the financial position of a company or a group. And the three main financial statements are the statement of profit or loss, right? Also known as the income statement. Then there is also the statement of financial position, also known as the balance sheet, and the statement of cash flows. Having gone through the CPS syllabus, we learned how to prepare the statement of profit or loss, right, which shows a company's revenues, expenses, and net income or loss for a given period. And it is prepared by subtracting the total expenses from the total revenues. The statement of financial position, on the other hand, candidates provides a snapshot of a company's financial position at a specific point in time. And it shows the company's assets, liabilities, and equity. The statement of cash flows, on the other hand, shows the movement of cash. We are talking of cash flow. It's just the movement of cash and cash equivalents into the company and out of the company during a given period. And it's divided into 3 or 4 sections. That is the operating activities, the investing activities, and the financing activities. So that's a general adumbrration of financial statements. Financial statements. I've highlighted 3 important financial statements, and candidates is on the basis of these financial statements that ratios, you can see from the syllabus, candidates are to learn how to analyze ratios. It is on the basis of these statements that ratios are computed, common size statements are computed, we have ratios, common size statements, trend, and cross analysis, cross sectional. This is cross sectional analysis, graphs, and charts. These I'm writing direct from the syllabus here. It's on the basis of these financial statements that candidates are required to compute ratios, to prepare common size statements, and trend and cross-sectional analysis, and graphs and charts. Graphs and charts. Then on the other page we have forecast statements, scenario analysis on the forecast. Now, for those of you appearing in the business data analytics paper, you will always have a question, expect to have a question on either preparation of ratios, common size statements, trend and cross-sectional analysis, graphs and charts, forecast statements, sensitivity analysis on the forecast financial statements, and also scenario analysis on forecast financial statements. I just took you through the December 2022 paper we've seen. There was a question on financial ratios. There was also a question on preparation of cash flows, which is a statement for analysis. So candidates, you were required to learn how to prepare these aspects based on the financial statements. Now we have, for example, the ratios, financial ratios. We know, candidates, that financial ratios are effective in analyzing financial statements. Why? Because they provide a standard method of comparing and evaluating the financial performance of a company over time or against its peers. We talk of cross-sectional analysis. And we know some of the common ratios could be the liquidity ratios, the investing ratios, and so on. These ratios are used to measure the financial health of a company, all right? They used to measure the investors, and analysts can gain insights into a company's financial health or strength or weaknesses. For example, a high liquidity ratio indicates that a company has sufficient cash to meet its short-term obligations, while a high debt-to-equity ratio may indicate that a company is heavily reliant on debt financing. So candidates, ultimately, ratios provide a comprehensive picture of a company's financial performance. It can also help investors and analysts make informed investment decisions. So below this video on the website, we will have financial statements and ratios calculated using Microsoft Excel. Then there is the common size statements. Common size statements, I know most of you are not hearing this term for the first time, because we know common size statements are also an effective tool for analyzing financial statements as they present financial data as a percentage of the company's total revenue or assets. All right? Percentages. And this allows for easier comparison between different companies and also provides insights into how a company is allocating its resources. Now, to prepare common size statements, for example, an income statement, you simply divide each line item by the company's total revenue. because in an income statement we have expenses and incomes. So you can get the total revenue. You can divide each item. For example, the expenses, divide by the total revenue, and you get a percentage. You understand? And that will give you a percentage breakdown of each expense and revenue item relative to the company's overall revenue. That's just an example. And candidates to analyzing the common size income statement, it can help to identify the trends and patterns in the company's expenses or even revenues. For example, you may notice that a company's cost of goods sold has increased as a percentage of revenue over time, indicating that the company is facing challenges in managing its production costs. So if the percentage of production costs is increasing, but the revenues are not increasing, then that will tell you that the company is experiencing challenges in managing production costs. That is common size income statement. A company may also prepare a common size balance sheet. And to prepare a common size balance sheet, candidates, you just divide each line item by the company's total assets. If it's inventory, take inventory, divide by the total assets. So each line, inventory, debtors, accrued expense, accrued income, and all that. And that will give you a percentage breakdown of each asset and liability item relative to the overall balance sheet total of assets, right? And then having done the percentages, you can now analyze the common size balance sheet to identify trends and patterns in the company's assets and liabilities. For example, you may notice that the company has a high percentage of, say, long-term debt relative to its total assets, indicating that the company may have a higher risk of default in the long run. So, just to help you remember what you covered, that's what we can say about the common size statements. Then the third item here is trend and cross-sectional analysis. Now, these are two different types of data analysis. That is, one, trend, then cross-sectional. Two, trend and cross-sectional analysis. Now, trend analysis is a method of analyzing data over time to identify patterns or trends. It involves comparing data from multiple time periods and examining changes over time to determine if there is any consistent upward or downward trend. It can be used in various fields, including finance, marketing, and so on. That is trend. You analyze data for different periods. Then you compare and see if there is any trend. Then cross-sectional analysis, on the other hand, is a method of analyzing data at a single point in time. And it involves comparing data from different groups or individuals at specific moment to identify patterns or differences. Cross-section. It's at the same time you can carry out an analysis, then compare at single point in time, then compare because you are analyzing different entities at the same time. So we shall be answering questions under cross-sectional analysis, like the question that was done in December 2022. That question, we have done it. Below this, at the end of this class lessons, you will see the solutions. We have solved one of the questions that was tested in testing the candidate's knowledge in preparation of cross-sectional, in analyzing statements using Excel. Graphs and charts. Now, financial statements can also be analyzed using graphs or charts. Using graphs or charts. All right? Why? Or how? Now, candidates, we know that financial statements provide critical information about the financial performance of a company, and analyzing these financial statements using graphs or charts can help to present the information in a more visual way. That can easily be understood. One example of a statement that can be analyzed visually or using graphs or charts is the income statement. You can use graphs or charts to illustrate trends in revenue and expenses over time. An example of a chart that can be used to do that is a line chart or even pie chart can be used to illustrate the composition of expenses or revenues. We know a balance sheet provides a snapshot of a company's assets, liabilities, and equity at a specific point in time. So you can use graphs or charts to illustrate the changes in the categories over time, like assets, liabilities, and equity can be illustrated using a chart, like a bar chart. It can be used to show the changes in asset categories over time. A bar chart can be helpful to identify trends in the value of specific assets or liabilities. We may also have things like stacked bar charts, which can be used to show the composition. You recall what we studied under the presentation. You recall in the topic on presentation of data, where we describe data in three types. I mean visualization in three types. Three types of visualization: comparison, composition, and relationships. And when studying this subtopic, we saw that stacked bar charts can be used to show composition of different variables. When visualizing a balance sheet, then we can compare the assets and liabilities. And that can help to identify which categories of assets or liabilities are increasing or decreasing over time. Thus, graphs and charts. The other item here is forecasting financial statements. Now, preparing forecast statements involves projecting the financial performance of a company over a future period, typically 1 to say 5 years, based on a set of assumptions. And the assumptions can include factors such as the sales growth rates, the cost of goods sold. There could be assumptions on operating expenses, capital expenditures, the financing activities, and so on.
That's where the syllabus reads, prepare, forecast financial statements under specified assumptions. So the assumptions can be in relation to the various elements in the financial statements. And there is a procedure or steps involved in preparing forecasted financial statements under specified assumptions. We're not going to the procedure. That we will do when we are doing the actual practicals in the core application area of financial accounting, and when doing it under using the software called Microsoft Excel. We will take you through the stages, the steps on how to prepare forecast financial statements under specified assumptions. Sensitivity analysis. Sensitivity analysis on the forecast financial statements is a technique. Sensitivity analysis is a technique that is used to understand how changes in key assumptions or inputs impact the output of a financial model. And when conducting sensitivity analysis on forecast financial statements, it is important to identify the key drivers of 1, revenue, 2, costs, and other expenses in the model. So sensitivity analysis on the forecast financial statements, I repeat, is a technique. Sensitivity analysis is what? Is a technique that is used to understand how changes in the key assumptions or the inputs impact on the output of the financial model. So here we talked about forecast financial statements under certain assumptions, which we said could include the elements in the financial statements. Sensitivity analysis is a technique used to understand how changes in such inputs or assumptions can impact the output of a financial model. And we'll be taking you through Excel on how to conduct sensitivity analysis on the financial forecasted statements. Sensitivity analysis on forecasted statements. It's a procedure that are steps that we will learn and which you need to familiarize with before you appear in your exams. Then lastly here we have scenario analysis on the forecasted financial statements. Forecast financial statements. Scenario analysis is yet another tool that is useful for assessing the potential impact of different future events on financial statements. Potential impact of different events on what? On the financial statements. So here the analyst will begin by identifying scenarios. Start by identifying the scenarios that he or she wants to analyze. For example, you would consider scenarios such as recession or a market downturn, or a major regulatory change. Those are scenarios. And an analyst would first of all identify such scenarios. Then the second step would be to determine the variables. Once the scenarios have been identified, then the analyst will determine the variables that are most likely to be impacted by
each scenario. For example, if you are analyzing recession, variables such as revenue, expenses, cash flows could be affected. Then the third step in scenario analysis could be to create the focus financial statements. The analyst may use the historical financial statements and any other relevant information to create a forecast for the financial statements. And that forecast should be based on the most likely scenario, all right, without any changes. Then step number 4 is to adjust the variables. Now for each scenario, you could adjust the variables that are most likely to be impacted. For example, if you are analyzing a recession, you would reduce revenue by a certain percentage and increase expenses due to high unemployment rates and so on. Then the analyst could then recalculate the financial statements based on the adjusted variables, and that would give you an idea of how the scenario could impact the financial statements. Generally, that is a procedure in a scenario analysis, which again will have an opportunity in Excel to conduct. In data analytics, we have many softwares that can help in scenario analysis. So be learning how to do it using Excel instead of just writing on paper the way we've been doing before. Now, with the computerization, it's now very easy with computers to carry out sensitivity analysis, scenario analysis, to do forecasts, even graphs and charts. By now, you know how to generate charts and graphs on Excel. It's just 3 clicks away. Then candidates, we've gone through the first bullet here, that is the first and second. Then there is data visualization and dashboards for reporting. You recall in the topic on introduction to data analytics, there was a subtopic on data visualization, particularly in Excel. There was also a topic on tools. So we will be looking at tools practically. We shall be looking at tools for reporting, like the Excel, the Power BI, there is the Tableau, the micro strategy tools that can be helpful in financial reporting and dashboard and reporting. So that will mark the end of our today's lesson, where we've introduced the first core application of data analytics, that is financial accounting and reporting. As I said, we will now, from our next session, look at the practical questions. We are going to solve practical questions in financial accounting and reporting using Excel. So I advise you to familiarize with the formulas, with the shortcuts in Excel as you are taught, or as we laid the foundation in the first topic, that is Introduction to Excel. Now the shortcuts and the functions that we covered in topic 1 are now required as we get into the core application of data analytics in different areas. Thank you. God bless you. Bye-bye.
Greetings, candidates, and welcome back to the lesson. The subject is Governance and Compliance Audit. The chapter is Post-Governance and Compliance Audit. Now, in Post-Governance and Compliance Audit chapter, we only have 2 sub-chapters. The one we studied in our last session, which is Nature and Scope of Subsequent Events, Then today we move to the general guidelines on subsequent events. Now, before we get into the guidelines, I want to reiterate that subsequent events, first of all, are significant occurrences, either favorable or unfavorable, that take place between the end of the audit period and the date the final audit report is signed. So in a governance and compliance audit, subsequent events are evaluated based on their impact on the audit's maturity score and the overall opinion on the organization's adherence to standards like the Institute of Certified of Secretaries of Kenya governance standards. And the subsequent events, they follow the logic of ISA 560, and due to that logic, they are classified into two, based on whether they confirm a pre-existing state or whether they introduce a new risk. That's why in our last session we said that subsequent events can be categorized into two, the adjusting and the non-adjusting events. There are two types. Type 1 is adjusting events. Adjusting events. Types A, adjusting events. This is just confirming. This is confirmatory. Events that happen after the end of the audit period and before or after the audit report is signed. So we have adjusting events. We've said in our last session that these events provide further evidence of conditions that existed during the audit period. And these events typically lead to change in the audit score or even modification of the audit findings. Examples of adjusting events could be legal settlement. Legal settlement. For example, a legal settlement. It could be a court ruling, say in March 2026, for a case that was active throughout the year 2025. So the audit period ends in, say, December 2025. This is the audit period ending December 2025, but in March 2026, this legal settlement, the court ruling in 2026, this is a subsequent event. This is an event that happens after the end of the audit period. Are you following, candidates? The legal settlement. So the ruling, this legal settlement only confirms whether the board's previous contingent liability, the contingent liability disclosure, it confirms whether the contingent liability disclosure was sufficient or if there was a systemic failure in the legal risk management. So this is an adjusting event. It confirms the condition that existed up to the audit period. That's one example of an adjusting event. Another example of adjusting event is discovery of fraud. Discovery of fraud. This means finding evidence, say in February. In February 2026, there is discovery of fraud. Okay? Finding audit evidence in February 26 of a kickback scheme. The fraud could be a kickback scheme that was operating secretly during the year ending December 2026. There was this secret scheme, kickback scheme, that was operating secretly during the audit period, but it has been discovered in February 2026. That is an adjusting event. That discovery proves that the internal control framework was not effective during the period under review. The period under review is December 20 up to December 2025. So the fraud is discovered in February 2026. This is a subsequent event. It happened after the end of the audit period. You understand? You may have things like tax audits. Tax audits. It could be a final assessment from the Kenya Revenue Authority that is received post-audit. After the post-audit, KRA conducts investigations or carries out an audit of the company, showing that, for example, tax filing errors were discovered and so on. Tax audit. That could also be a subsequent event that is that happens after the audit period. So these are just giving examples, candidates. It could be regulatory fines. Another example, regulatory fines. For example, receiving a formal penalty notice from the Office of the Data Protection Commissioner in, say, early January. It could be early January 2026. This is after the audit period. The company is fined. It could be for data breaches that occurred in 2025. And that confirms non-compliance with the Data Protection Act. That means that the company did not comply with the Data Protection Act in the year 2025. And that may happen post the date, okay, post audit date. So that is another example. So let's move to non-adjusting events. This is another type, non-adjusting events. Non-adjusting events. Non-adjusting events, these are disclosures. These are new events that did not exist prior to the audit period. These relate to conditions that arose after the audit period. These are conditions that arise after the audit period. They do not change the 2025 score, but they are so material that they must be disclosed to ensure the report is not misleading. One example could be board resignations. Say 40% of the board members have resigned. Sudden resignation of, say, 40% of the board. For example, the chair has resigned, the audit committee lead has resigned in January, immediately after the audit, or March or February. Now, while the 2025 board was stable, the 2026 board is now in a governance crisis. When you are auditing this company in 2025, the board was intact. But in February, 40% of the board members have resigned. So that is a non-adjusting event. This is an event that is arising after the audit period. It may not change the 2025 score, but is a serious matter that needs to be disclosed so that those who are relying on the 2025 report are not misled. Mergers and acquisitions. Mergers and acquisition. It is a merger or the company has acquired another company. Signing a deal to be acquired by a foreign entity 2 weeks, say, after the year 2025 audit period, that significantly changes the organization's stakeholder landscape. It is an event that did not exist in 2025, but in 2026, that is the position. We have merger or so That is another non-adjusting event. It could be major disaster. Major disasters could be a fire outbreak that demolishes the entire server room, a fire or a cyber attack in February 2026 that destroys the company's primary data center, and that tests the business continuity plan and must be disclosed as a significant risk to governance in future. It has to be disclosed. Example for new legislation. These are examples of candidates of non-adjusting event. There's a new legislation, for example, the enactment of a new law, or it could be change in a company, the Companies Act. So that did not exist in 2025, but that happens after 2025, say in February 2026. A new legislation that makes previous best practices now mandatory requirements. We are new provisions that did not exist in 2025, but because of the new law, what was regarded as best practice now becomes mandatory requirement. So that's it, candidates, for the types. We are discussing post-governance and compliance audit, the adjusting and non-adjusting events. This is just to reinforce what we did in our last session. So let's now shift to guidelines. That is our focus for our today's lesson. This was to reinforce what we covered in our last session, these events. Adjusting events, non-adjusting events. Today we are focusing on the general guidelines for auditors when it comes to subsequent events. Guidelines. Now, the auditor's objective, candidates, in regard to subsequent events is to ensure that the report reflects the true and current governance state of the entity at the time of signing. That's the objective. That's why an auditor has to conduct what we call proactive procedures. Proactive procedures. Because at the end of the audit period, as an auditor, you may not be aware of some of these events you are talking about. And that's why you need to be proactive as a governance and compliance auditor so that you can discover some of these guidelines. Because your objective as an auditor is to ensure that the report that you are issuing to the stakeholders reflects the true and current governance state of the entity at the time of signing that report. But you've seen there are some events that may occur, like the adjusting events, which may force you as an auditor to adjust your audit opinion. So that's why you have to be proactive. As the report date approaches, as an auditor, you should inquire with management. One, inquire with management. And what are you inquiring about? You need to specifically ask the CEO or the company secretary if any material non-compliance has occurred since the field work ended. Then you become another way proactive through reading. You read minutes before the report is signed. Read board minutes. Review minutes of any board or committee meetings that is held after the audit period. That would be, say, you check if there was if the audit period ends, as we've been discussing, December 2025, then you need to check if there was any board or committee meeting in January 2026, February 2026, March 2026. That is before the report is signed. You check if there were any changes or any information that relates to the subsequent events. 3, search regulatory portal. Be proactive by searching the regulatory portal. Regulatory portal. Check for new filing on eCitizen or Business Registration Service to ensure there is no late filings or changes in beneficial owner during that period. So these are just 3 ways to become proactive. This is a guideline to help you ensure that the report that you are issuing is reflecting the true and current governance state. Then, of course, there is number 2, response to material deviations. Responses to material deviations. Responses to material deviations. If an event is discovered that significantly changes the governance score, then you can evaluate disclosure. One thing you do is to evaluate disclosure. Evaluate disclosure. Determine if management has disclosed the event in the notes or the chairman's statement. Then you can report modification. Report modification. What do you mean by reporting modification? If that means that if the event indicates a systemic failure in governance, like massive fraud uncovered post-audit, then the auditor may need to modify the governance and compliance opinion. To modify the opinion if it is significant. That's a very important guideline. Then number 3, communication. Communicate. Inform those charged with governance immediately in order to discuss how the events impact the final scoring. You have to communicate immediately. Those charged with governance, that could be the audit committee, the board of directors, the CEO, the senior management, and so on, including the company secretary. Then, of course, another guideline would be in relation to the responsibility of management. Management's responsibility. Management's responsibility. What is the management's responsibility when it comes to subsequent events? Now, under the ICS governance standards, the responsibility to keep the auditor informed rests with management. So the management have a duty, first of all, to disclose. Duty to disclose. The management has a duty to disclose. The management must proactively notify the auditor of any significant fact that comes to light before the report is issued. Then they need to update the compliance matrix. They have a duty to update compliance matrix. The management have a duty to update the compliance matrix. That means that if a subsequent event resolves a previous gap, for example, a missing policy is finally approved, then management should update the matrix and provide the signed artifact to the auditor for verification. So that is the management's responsibility, and that is the end of the lesson on the general guidelines when it comes to subsequent events. And in closing, candidates, we need to remember that if a material fact becomes known after the governance audit report has been issued, then the auditor is required to take action.